Gimana? Hah?
Ini.
Hah?
Enggak, yang sebelahnya.
Oh, sorry.
Yang tengah.
Ini klik. Nih.
Iya. Yang mau di ini nama yang bawahnya ya, digedein ya.
Nah, makanya tapi kalau digedein di baris yang lain nggak cukup karena ada panjang itu loh. Apa sih namanya auto itu?
Yang biar turun ke bawah ya?
Enggak, besar kecilnya loh bro.
Ikatan Akuntan Indonesia, akuntan profesional unggul Indonesia maju. Ikatan Akuntan Indonesia, IAI, telah berkiprah mendukung pembangunan SDM dan transformasi ekonomi Indonesia.
Akuntan memiliki peran penting dalam pembangunan nasional yang berkesinambungan.
Profesi akuntan mendukung upaya peningkatan profesionalisme SDM Indonesia agar bisa optimal berkarya mendukung pembangunan ekonomi yang efisien dan transparan. Melalui Prakarsa 6.1 yang telah ditetapkan sebagai program umum Dewan Pengurus Nasional IAI periode 2018-2022, IAI siap berkarya mengawal perekonomian bangsa ini menuju Indonesia Emas 2045.
Saya sangat mendukung rencana IAI untuk mempercepat program sertifikasi agar para akuntan di negara kita memiliki kreativitas, inovasi, keterampilan, dan memiliki daya saing, dan sekali lagi dalam rangka mendukung pengembangan ekosistem kita yang lebih akuntabel, lebih efisien, goal-oriented, dan inovatif.
Tanggung jawab itu terwujud melalui Chartered Accountant Indonesia sebagai identitas akuntan profesional Indonesia dan telah mendapat pengakuan kualitas secara global. Prakarsa 6.1 berisi 6 langkah aksi dengan satu tujuan strategis untuk memperkuat peran IAI dalam meningkatkan kepercayaan masyarakat terhadap entitas bisnis dan publik dengan menyiapkan akuntan profesional berintegritas siap menghadapi masa depan. IAI melaksanakan tugas dan tanggung jawabnya menyusun standar akuntansi keuangan dan standar profesi, melaksanakan ujian sertifikasi, serta aktivitas keprofesian lain mengacu kepada International Federation of Accountants dan Chartered Accountant Worldwide. IAI for Society dijalankan untuk memberikan manfaat yang semakin besar bagi masyarakat serta untuk mendekatkan profesi kepada publik. Founding Fathers IAI telah menetapkan 2 tujuan pendirian IAI. IAI dibangun untuk mempertinggi mutu pendidikan akuntan dan meningkatkan kualitas pekerjaan akuntan Indonesia. IAI menguasai perubahan, menyiapkan masa depan.
The Honorable President of Institute of Indonesia Chartered Accountants, who also the Chairman of Komwasjak Ministry of Finance, Bapak Profesor Mardiasmo, the Honorable Assistant of Minister for Tax Compliance, Ministry of Finance, Bapak Yon Arsal, the Honorable Director General, Directorate General of Custom and Excise Indonesia, Bapak Heru Pambudi, the Chairman of Institute of Indonesia Chartered Accountant Tax Accountant Compartment, who also Director of International Taxation DGT Indonesia, Professor John Hutagao, Managing Director Biru Fandi, a Moody's Analytics Company, Mr. Kisodial, Member of IAI National Council, Council Member of IAI Tax Accountants Compartment, our dearest colleague from ASEAN Federation of Accountants, the honorable speakers and moderators, and all the distinguished guests, participants, ladies and gentlemen. Good afternoon and welcome to the Virtual International Tax Conference 2020 with the theme Current Update International Taxation Development. This is the seventh collaboration between IAI Tax Accountant Compartment, IAI KAPJ, and Biru Fandi, a Moody's Analytics Company. And this year, we will deliver this 2 days conference virtually. Ladies and gentlemen, before we start the event, we would like to invite you to sing the national anthem Indonesia Raya. Ladies and gentlemen and the distinguished guests, to deliver the opening speech, we would like to kindly invite the Chairman of Institute of Indonesia Chartered Accountant, Professor Mardiasmo, to deliver the opening speech. Professor Mardiasmo. Profesor Mardiasmo.
I think Pak Mardiasmo, the video is disabled and also the volume is also still unmuted.
Yeah. Okay. Ladies and gentlemen, apologize. We would like to ask Professor John Hutagao as the chairman of IAI KAPJ to deliver the opening speech. For Professor John Hutagao. Ladies and gentlemen, Bapak dan Ibu, we would like. Bapak dan Ibu mohon ditunggu, kami sedang menunggu kehadiran Bapak Profesor Mardiasmo yang sedang mencoba untuk kembali masuk ke dalam room webinar ini. Sekali lagi Bapak dan Ibu, kami mohon untuk menunggu perkenannya untuk menunggu kehadiran Profesor Mardiasmo untuk memasuki webinar ini.
Very good afternoon, everyone. First of all, allow me to greetings Pak Heru Pambudi as the Director General of Custom and Duty, Pak Yon Arsal as expert to Minister of Finance, and also I saw here my dear colleague Pak Estu Yoga as the Director of the Public Relations, Director General of Taxes, and Andrew Arbah as a senior expert from the OECD assigned in Jakarta office, and all panelists that I couldn't mention one by one. Thank you very much for your attendance and participation in the 7th International Tax Conference held by Indonesian Accountant Chapter for two days, started from this today and tomorrow. The aiming of this conference is to update the stakeholders relating to the current developments of international taxation affairs that already being discussed by most international forum. For example, how to determine the nexus and methods of profit allocation amongst jurisdictions due to the development of ICT. And also another topic discussed regarding to transfer pricing.
Pak Mardiasmo.
And it is a common and classic tax dispute arising in the world. And last but not the least, also discuss about multilateral instruments that is needed to accommodate the BEPS action related to avoid any aggressive tax planning. I hope this international tax conference will be fruitful for us in order to know the development of international taxation issue. Again, without further ado, I would like again to thankful for all participants, especially the presence of Pak Heru Pamudi and also Pak Yon Arsal to give a keynote speech before we starting the discussion with the panelists. Thank you very much for your attention. Have a nice seminar. Now I return back the floor to the MC, Ms. Monica Nabila, please.
Thank you, Professor John Hutagaul, for the warm welcome. Ladies and gentlemen, Bapak dan Ibu, today's conference theme is current update international taxation development. We will going to have discussion on taxation policy measure dealing with COVID-19 pandemic, and also taxation matters arising from digitalization. We will also have a keynote speech from the Director Center of Tax Policy and Administration, and also the discussion about current update of transfer pricing development and dispute settlement. So make sure you will stay with us for the next 2 days.
Udah. Masih. Matikan.
Halo, Profesor Mardiasmo.
Ya. Alhamdulillah. Ya, sorry.
Okay.
I do apologize due to technical.
It is okay. So, ladies and gentlemen, we already have Professor Mardiasmo here with us in this room. So without further ado, please, we would like to hear the opening speech from the Chairman of Institute of Indonesia Chartered Accountant, Professor Mardiasmo. Professor Mardiasmo, the floor is yours.
Bismillahirrahmanirrahim. Honorable Indonesian Director General of Custom and Excise, along with the staff, Pak Heru Pambudi, apa kabar? And also Honorable Assistant of Minister for Tax Compliance, Minister of Finance, Pak Yonarsal, apa kabar Pak? And Honorable Chairman and Management of Tax Accountant Department, KAPJ IAI, Honorable Bureau Vantage, BFD, Management and Representatives, Honorable Speakers, distinguished guests, ladies and gentlemen. Assalamualaikum warahmatullahi wabarakatuh, and good afternoon to you all. Praise to God Almighty. Today, we can hold a virtual international tax conference with the theme Current Updates of International Taxation Development. Ikatan Akuntan Indonesia, Tax Accountant Department, or KAPJ IAI, again held the 7th consecutive collaboration with the Bureau Vantage and 6 times as International Tax Conference, or ITC. This event is also supported by Directorate General of Taxes and Directorate General of Custom and Excise, Ministry of Finance, Republic of Indonesia. International Tax Conference presents diverse and special speakers, consisting regulators and tax experts from within and outside the country. This activities aims to provide to update information on regulation and practices that occur in the dynamic of international taxation. With the COVID-19 pandemic situation, the 2020 ITC and held virtually with Zoom seminar platform. It is such a pity that we can meet and discuss physically. But by going virtual also brings a lot of opportunity for ITCs. Besides, more international participants are able to join. We are honored that Mr. Pasal Sins Amans, Director of OECD's Center for Tax Policy and Administration, will deliver keynote speech in day 2 of 2020 virtual ITC tomorrow afternoon. Ladies and gentlemen, fiscal year 2020 is a great challenge for global tax as impacted by the COVID-19 pandemic, and it is still continues until present. The COVID-19 pandemic has upended daily life as a country's attempt to protect the health for their citizens and mitigate the economic fallout from the ongoing crisis. And in responding to this crisis, the tax agenda is more relevant than ever. Fiscal measures have played and will continue to play a critical role as a countries continue to navigate their way through the COVID-19 crisis. In addition, issue on digital tax also is still on progress. For months, Organization for Economic Cooperation and Development, or OECD, has been working towards a multilateral solution to this challenge, with the goal of developing a new international tax framework by the end of 2020. And still, transfer pricing plays an important role, which if it is mishandled, it can be costly for stakeholders, resulting in audits, adjustment, penalties, and double taxation, not to mention litigation. Responding to these challenges, the OECD in February 2019 released a public consultant document involving 127 member of countries of the BEPS inclusive framework entitled Addressing the Tax Challenges of Digitalization of the Economy. The policy options described in this document are grouped into two separate policy pillars. The first pillar concerns a more equitable profit allocation policy, and the second pillar concerns the policy of implementing of tax-based sourcing prevention instrument through a minimum tax. The first pillar contains policies to allocate more profit or profit to countries where the market is located, or to market countries, regardless of the presence or absence of physical presence. The challenge is the international taxation system has assumed the obligation to pay taxes in a country arises when there is a physical presence. In fact, many giant technology companies actively explore various countries without a physical presence. Ladies and gentlemen, another challenge we recognize is digitalization. It has created complexities for authorities and the business sector to determine taxation rate on income generated from cross-border transactions. It is not easy to determine the place where value creation is added to the goods or services being transacted. Especially in reality, many companies operating across countries try to take advantage of the gray area. The rapid digitalization also affects the transfer pricing activities of multinational companies. With the different taxation system in each country, the potential for increasing dispute is also inevitable. In this context, the certainty of taxation is crucial. Again, the certainty of taxation is crucial. With all these challenges, I appreciate the KAPAJ IAI for holding the Virtual International Tax Conference 2020 as the 7th consecutive event in collaboration with the Bureau Vantage, a Moody's analytics company, and with the support from the Indonesian Director General of Taxes and Director General of Custom and Excise, Ministry of Finance. So thank you, Pak Yon Arsal, and also Pak Heru Pambudi. Ladies and gentlemen, once again, I would like to express my gratitude and highly appreciation to KAPAJ IAI, Bureau Vantage, and Director General of Tax and Director General of Custom and Excise, all speakers, participants, and all parties who have organized this event. I'm sure this event will have a very positive impact on Indonesian taxation and certainly for the development of Indonesian economy, as well as for the development of the Indonesian accounting profession. With this, I officially open the Virtual International Tax Conference 2020. Hopefully, this event will provide us an optimal mutual benefit. May God the Almighty always bless our good intention. Thank you very much. Assalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam warahmatullahi wabarakatuh. Thank you, Professor Mardiasmo, for the opening speech. Ladies and gentlemen, we would like to humbly invite Professor Mardiasmo, Bapak Yon Arsal, Bapak Heru Pambudi, Bapak John Hutagaul, Mr. Kisodial, Ibu Eli, Bapak Edward Tanujaya, dan Bapak Hestu Yoga for take a group picture. So you may turn on your video and we will take the screenshot from here. This is our new kind of group picture. So yeah, please turn on the video and smile. Oh, everybody looks very happy today. Thank you
Yes.
very much.
Very handsome also.
Yeah,
Especially Pak Heru Pambudi.
Ya,
Siapa?
terima kasih Bapak dan Ibu. We will continue our next agenda. Now we would like to invite the Directorate General of Custom and Excise, Ministry of Finance, Bapak Heru Pambudi, to deliver the keynote speech. Bapak Heru, the stage is yours.
Thank you, Bu Monica. Your Excellency, Pak Mardiasmo, the Chairman of the Institute of Indonesia Chartered Accountants. Selamat siang, Bapak.
Ya.
Hormat. Honorable Assistant of Minister of Tax Compliance, Pak Yonarsal, and also my colleagues from Digitex, with us, Professor John Tagaul, Pak Estu, and I see some others. Distinguished resource person and all the participants of Indonesia International Tax Conference 2020. I see my old Pak Kisodial. I still remember you, Pak. And ladies and gentlemen, Assalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam.
Good afternoon to all of you. First of all, I'd like to thank for this opportunity. Thank you very much, Pak Mardiasmo, for giving us the room in this meeting to deliver our policy, the latest policy, and the implementations. So today, the Indonesia Institute of Chartered Accountants is holding the great event with the title Current Update of International Taxation Development. On the first day, this event aims to discuss the taxation policy measures to deal with the COVID-19 pandemic and the taxation matters arising from digitalizations. So, in these particular occasions, let me share with you the following two topics. First, I'd like to share with you how we, Indonesia Customs, quickly respond to the pandemic to assist the society and also business community. Secondly, I will share the current customs policy in relation to the massive digitalizations. Ladies and gentlemen, as we understand and know, the world remain gripped by the COVID-19 pandemic. This pandemic does not only affect our health, but also hit the economy of the country around the world. COVID-19 has shaken global economic growth and caused a significant negative impact on almost every vital sectors, including also here in Indonesia. The impact of the this virus outbreak is undeniable to Indonesia economy. To maintain the economic situations, our government has issued several incentives to help the society and industry survive these situations. As part of the government's, Indonesia Customs delivers two main strategies. First, the bleeding stop strategy, and the second is fast recovery strategy. The bleeding stop strategy focuses on health side. We support the Indonesia government in providing the goods needed to stop the spread of the COVID and treat patients. DGCE or Indonesia Customs grant exemptions to import in form of import duty, free or not imposing excise, and also give exemption in terms of value-added taxes, luxury sales tax, and also income tax under Article 2022, which is import tax, for the importation of goods related to healthcare, especially those related to COVID-19 treatment. Normally, the facilities, which I mentioned before, apply only healthcare related goods that are imported by the government's agency or non-profit organizations. However, in these situations, the government give facilities also for any goods that are imported by private sectors and personal importers, as long as it is related to the COVID. DGCE or Indonesia Custom also provide procedural incentive despite the fiscal incentive, as I mentioned, to expedite the import procedure for the goods required to control the virus. Customs, in collaboration with the National Agency for Disaster Countermeasures or Badan Nasional Penanggulangan Bencana or BNPB, have developed an automation systems that can process the licensing related to the import recommendation and the import duty exemptions in parallel. So, ladies and gentlemen, I can update more detail on this, that only within 2 weeks, we, together with the IT divisions in the Indonesia Customs, also under the Ministry of Finance, and also together with the BNPB and also the Ministry of Health, has developed successfully the integrated systems which allow importers of healthcare product can apply import duty exemptions and also import tax exemptions by online. This is very good policy and also implementation, because during that day, we understand that it's like a rush situations. Anyone want to release the goods as soon as possible without any delay. So by developing this online systems, I think we can address the issue and also give the best service for community. In terms of excise, Customs and Excise Indonesia also grants several relaxations, such as exemptions for ethyl alcohol for social purposes. We know that ethyl alcohol is goods that is needed to produce hand sanitizer, something like that, antiseptic and other goods that is necessary that day. Ladies and gentlemen, this is the policy and implementation that was introduced during the first or 2 weeks after Indonesia declared of this pandemic. We call it the Stop Bleeding strategy. Now, after several weeks, of course, we cannot stay only in the emergency situations. We have to also parallelly develop or improve or increase the activities of production, trade, and other activities to improve the economy. So we call it the second strategy as the fast recovery strategy. If the bleeding stop strategy focus mainly on health aspect, the fast recovery strategy focus on the economic aspect. Indonesia Customs and Excise has provided various fiscal and procedural incentive to prevent and restore the decline in economic performance due to the impact of coronavirus. The fiscal incentive were granted in the form of income tax exemptions to companies using bonded zone, for example, and ease of import activities for export and purpose of or KITE companies or perusahaan KITE. And we get the update, or we understand from the survey that reveals, survey also done by us and also done by some other organizations, reveals that the business prefers actually procedural incentive to the fiscal incentive. So we cannot only give the fiscal incentive, but we also have to give the best service in terms of procedural. In relation to this, Customs has provided some procedural facilities such as simplification of certificate of origin. Why certificate of origins? Because that day we saw that everyone was afraid to go outside, including to go to the customs service office. So we were thinking hardly that day. We were thinking very hard that how to still give the very good service without risking people. So we introduced what we call the paperless FTA in terms of presenting the COO. Another innovation or policies such as the extension for the due payment of excise duty, on which the aim to increase cash flow for the cigarette factories. Why cigarette factories? Because there are so many laborers working in the cigarette factories. So we have to save them. The local sale relaxation for bonded zone dead stock. This is also what we do. The exemption of export restrictions for medical products that are domestically oversupplied. At the beginning, we really depend on the imports, but after some modification of production in some companies, then we realized that we oversupplies of some product like masker, something like that. So we allow them to export and we support them. And also we establish what we call the national logistic ecosystems to overcome the logistic bottleneck so the business sector can rebound fast. This is also a very significant and a very big project. So during the COVID-19 pandemic, Customs also maintained its performance and innovation by implementing health and safety protocols in providing our service, such as using virtual media like today, like this time, to coordinate with both internal and external parties, limiting direct or physical contact with the clients, increasing selective supervisions, and developing remote audit, e-monitoring, e-auditing in development, custom, and excise audit. This is also some idea or innovation that was created very fast and very quick. And the response and the output and the outcome is very good, in fact. So ladies and gentlemen, besides bringing an adverse effect, this COVID pandemic has apparently also acted as an accelerator or catalysator, something like that, for the digitalizations of information technology and communications in our organization and also in Indonesia. This digital era has affected many sectors in business, from communication to new pattern of business transactions. And to answer the business sector demand for digital technology, we also working to modify our service, procedure, business process in order to adapt to new pattern of digital businesses. Let me share some policy or innovation that we already introduced and apply. The first one is what we call the National Logistic Ecosystems, or NLE. This concept is to collaborate or merge any existing information and technology systems of entities related to logistics, including governments, banking, shipping agencies, port authorities, trucking companies, warehousing, and some others. The NLE is a comprehensive logistic chain collaborations from the upstream to the downstream. It promotes and simplifies licensing payment and submission of document into a single process. The government just introduced these systems, I think last week, introduced by the ministers, Minister of Finance, also the coordinate Minister of Pak Luhut, and also some others ministers. The governments inform us that the NLA has been applied and has been run, and it already gave some benefit for us. With NLE, we hope that the digital business players would be easily connected so that the tax reporting can be automatically generated and the custom duty and tax payment can be integrated with other payment such as its freight, port handling, and the good costs that are usually paid in the marketplace platform. So we now offers to any platform or to any business systems to join us under the national logistic ecosystems. By doing so, we can reduce the logistics service time and push the logistics cost efficiency. This is very ambitious project, ladies and gentlemen, Pak Mardesmo especially, because we want to reduce the logistic costs from currently 23.5, and we are hoping very much that during the 5 years time, we can reduce hopefully about 16 to 17% only. So we can expect to reduce 6 to 7%. This is very ambitious because we want to be competitive compared to, for example, our neighbors like Malaysia and also Thailand and Vietnam, which is already below our performance, better than our performance. Another innovation is regulations, the changings of regulations. We modify any regulations because we understand fully, we fully understand that the regulations was set up or was created or was issued during the normal time. So when we face this pandemic, I strongly believe, and also it happens to any organization, I believe, that the regulations does not fit anymore with current situations. So because of that, we have to work very hard to, as quickly as possible, modify the regulations in order to give rooms for a new normal environment. This is very important. And we, under the Customs and also Ministry of Finance, already understand and already aware about this, and we do as quick as possible. I already mentioned about the paperless of the COO, one of the examples. The others is, let me directly jump to the what we call the remote audit and e-audit. So during this pandemic, our supervisory functions must keep running. We cannot, dismiss our functions because we cannot go to the physically go to the company. So we developed this policy. We develop remote audits because of travel limitation, of course. With remote audit, we can conduct custom and excise audit off-site, assisted by the use of digital technology. We do this by following the guideline created by accountant. Prof. Mardiasmo, in this opportunity, I'd like to thanks because Pak Mardiasmo and also many of your members give us idea and assistance in order to develop this policy and systems. So Pak Kusari, together with your team, already discussed many times, and I think one of the output is what we call the remote audit or e-audit. Furthermore, in the future, we are thinking about developing e-audit by conducting audit through computer with computer. The number of audits will increase, the audit completion time is faster, and the audit cost can be minimized. So by this, we are hoping very much that the audit coverage will increase significantly. Other than that, also we are developing new thinking of working. We develop what we call the flexible working space under the policy of the Ministry of Finance, flexible working hours, and activity-based workplace. I don't want to explore more about this because I think every agency already see this opportunity to anticipate and to make the functions rolling smoothly. By implementing this new approach, Indonesia Customs has managed to increase its service to the stakeholders to even a higher level. And also we are collaborating with Marketplace. The latest update that I can share with you, ladies and gentlemen, is that we offer a direct payment from Marketplace with our computer-based systems. So if a marketplace agree with these systems, then they can collect on behalf of customs. So any payment, the number of payments can be done in advance. While the product arrives in the port, especially in the airport, everything has been done. And we can serve them as fast as possible to release the goods outside to the domestic circulations. This is the latest update also. And the last one is the IT-based enforcement. We suddenly realized that the smugglers or the people who want to avoid custom duty, sometimes, not sometimes, now they are using the internet as base to sell the product. Now we are patrolling over the internet. I think this is the idea behind these innovations. So we set up a special team to supervise the internet data and informations. This innovation aims to protect the legal and reputable traders who already pay the duty. And the last thing that I want to share in this good opportunity is customs cannot face or contain the pandemic by ourselves. This is, we understand that. So I, on behalf of our team, we invite this institute to collaborate with us. in addition to whatever that we already achieved together. I strongly believe that this institute, with all members, have so many ideas that we can discuss and also apply. Hoping that with these discussions, we can improve our service and make the environment, the business environments more conducive and more better. And with that, I once again thank you very much for any contributions, any advice, and any collaborations from these institutes with Indonesia Customs. And also, I thanks to colleagues from Pajak, Pak Yon, Pak John, and Pak Hestu, and also from the OECD and Bureau Pandij. Thank you. Assalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam warahmatullahi wabarakatuh. Terima kasih Bapak Heru Pambudi atas keynote speech-nya. Thank you, Mr. Heru Pambudi, for the keynote speech. Ladies and gentlemen, now we would like to kindly invite the Honorable Directorate General of Taxes Indonesia and Ministry of Finance. I'm so sorry, I would like to kindly invite Bapak Yon Arsal, the Assistant of Minister for Tax Compliance, Ministry of Finance, to deliver the keynote speech. Bapak Yon Arsal, kami persilahkan.
Terima kasih, Bu Monica. Selamat siang, Pak Mandesmo, Pak Prof. President of Institute Indonesia Chartered Accountants, Bapak Mardiasmo, Director General of Customs and Excise, Bapak Heru Pambudi, Managing Director of Bureau Pandij, Mr. Kisodayo, Director of Center of Tax Policy and Administration of OECD, Mr. Pascal Senamans, Chairman of Institute of Indonesian Chartered Accountants, Tax Accountant Compartment, Professor John Hutagao, speakers, moderators, participants, organizing committee, ladies and gentlemen, Assalamualaikum warahmatullahi wabarakatuh. Good afternoon, all of you. Allow me for this opportunity, Pak Mardiasmo and organizing committee to speak on behalf of Pak Suryo, our DG. First of all, I would like to begin by thanking IAI for giving us an opportunity to deliver a keynote speech at the early part of this two-day conference, during which we will discuss a number of current issues in the international taxation, such as taxation on digital economy, recent development in transfer pricing and dispute settlement, and the multilateral instrument. In addition, there will also be panel discussion on taxation policy measure in dealing with the COVID-19 pandemic, where we can share ideas and countries' experience during the pandemic. Ladies and gentlemen, the COVID-19 pandemic has brought about an adverse impact to Indonesian economic condition, and we are for sure doing our best to prevent financial instability and economic crisis due to this COVID-19 pandemic.
Yang ditulis di warna kuning. Welcome the reports on the blueprint for Pillar 1 and Pillar 2 adopted by
the Indonesian government has taken several strategic measures to help our people and business recover from this difficult situation. One of the measures is the provision of tax incentives. There are a number of specific tax incentives that we have been providing this year based on the regulation of Minister of Finance number 110/2020 in response to the COVID-19 pandemic. First, employees and laborers with annual gross income not exceeding 200 million rupiah per year have been provided with Article 21 income tax incentive. Their tax will be borne by the Indonesian government until December 2020. Second, micro, small, and medium enterprises with annual turnover not exceeding 4.8 billion rupiah do not have to pay their businesses tax until December 2020, as the government will pay it out. Third, a 50% reduction on income tax monthly installment has also been granted until December 2020 for specific taxpayers, as well as those who obtain import facilities for export purpose KITE and those who are in bonded zone, kawasan berikat. Fourth, exemption of income tax on import activities until December 2020 for specific taxpayers, as those who obtain also import facility for export purposes, kemudian import tujuan ekspor kita, and those who are in bonded zone or kawasan berikat. And fifth, low risk taxpayers with value added tax overpayment not exceeding 5 billion rupiah may enjoy an opportunity for preliminary refund until December 2020. Several other tax incentives have also been given to support our medical efforts in dealing with the pandemic as stipulated in the government regulation number 29 year 2020. First, taxpayers who produce medical equipment and household medical supplies, including surgical masks and gloves, respirators, ventilators, hand sanitizers and disinfectant, diagnostic reagents and self-protection equipment, such as medical coveralls, heavy-duty aprons, goggles, and face shields, may obtain an additional deduction in their taxable income by 30% of the production cost of those equipment and supplies. Second, taxpayers who make donation to national or local disaster management agency, Ministry of Health, Ministry of Social Affairs, and other donation collection institutions may deduct such a donation from their taxable income. Third, a 0% income tax on honorarium and other remuneration received by taxpayers who become medical officers that provide medical service in relation to the COVID-19 pandemic. And fourth, a 0% income tax on government compensation for the use of taxpayer asset in dealing with the COVID-19 pandemic. In addition to the provision of those tax incentives, we also have provided a relaxation in our tax administration by extending deadlines for taxpayers in exercising their tax right, such as right to apply for a refund and to file an objection. Ladies and gentlemen, this year, international taxation has entered into a crucial time with many aspects being discussed. Digital economy is one of the actual issues in international taxation. The inclusive framework on BEPS has been discussing the development of Pillar 1, which will distribute taxing right on digital business among relevant jurisdiction, and Pillar 2, which will act as anti-base erosion measure through the income inclusion under tax payment, switchover, and subject to tax rules. As far as I understand, the inclusive framework of BEPS will have another meeting the day after tomorrow to continue the discussion, and we're hoping that a global consensus can be reached by the end of this year. As one of the G20 members, Indonesia support the development of direct taxation policy on digital economy. I would also like to inform you that we have already taken a measure in terms of indirect taxation by imposing value-added tax on the utilization of intangible goods and services abroad in Indonesia. This indirect taxation policy puts foreign electronic commerce into a level playing field with domestic businesses which have been subject to value-added tax prior to this policy. A number of foreign digital platforms have agreed to collect value-added tax on their transaction. Ladies and gentlemen, the other actual issue in international taxation is current development in transfer pricing and dispute settlements. After developing BEPS Action 4 on interest deduction and BEPS Action 8 to 10 on intangibles, contractual allocation of risk and other high-risk area, the OECD has been mandated with a follow-up work on the transfer pricing aspect of financial transactions. The result is the publication of transfer pricing guidance on the financial transaction in February 2020. In dispute settlement, the OECD makes an Action 14 on improving dispute resolution as a minimum standard on BEPS, and I'm pleased to let you know that Indonesia has considered recommendation of BEPS 14 in formulating regulation of Minister of Finance number 49 year 2019 on mutual agreement procedure. While the regulation acts as domestic law, dispute resolution provision in Indonesian tax treaties have also been in line with BEPS Action 14 through modification under multilateral instruments. Indonesia has also updated its regulation on advance pricing agreement with regulation of Minister of Finance number 22 year 2020. Those two regulations have been issued in order to provide taxpayers with legal certainty in the prevention and settlement of international taxation disputes. Speaking of the multilateral instruments, Indonesia has signed the convention at the first opportunity on 7 June 2017 and has ratified it by Presidential Regulation number 77 year 2019. The instrument of ratification has been submitted to the OECD as depository on 28 April 2020, and we're hoping that the convention may enter into the effect, modifying our tax treaty as of January 1st, 2021 for withholding tax, and as of January 22 for other taxes. Other than improving dispute resolution mechanism, we expect to strengthen our tax treaties and prevent those from being abused inappropriately by implementing the principal purpose test on the substance of transaction that results in relevant treaty benefits. We also expect to prevent artificial avoidance of permanent establishment status in the context of dependent agent, exclusion of specific activities from permanent establishment definition, and construction activities. Ladies and gentlemen, at the end of this speech, I would like to thank all of the parties involved in preparing this virtual conference, and I wish you fruitful discussion during this conference. I also hope that we all stay safe and sound during this difficult time, and I am certainly looking forward to the end of this pandemic so that we are able to directly meet one another in the future. Thank you. Wassalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam warahmatullahi wabarakatuh. Thank you very much. The Assistant Minister for Tax Compliance, Minister of Finance, Bapak Yon Arsal. Ladies and gentlemen, before we enter the panel discussion one, please let me read the housekeeping rules. The first one is we recommend accessing this webinar from your desktop or laptop and using the headset for maximum experience. Should you having an internet problem, please turn off your video for better connection and use audio only. During the webinar, please post your question at Q&A menu, mention your name, institution, and to whom your question asked. This webinar will be recorded. If you experience any trouble or issue during the webinar, please contact Faiza Faisal or Nurul Gunawal. Please contact IAI if you require a certificate of attendance of this webinar at our email, ppl@iaiglobal.or.id. Ladies and gentlemen, let us start our event today for the panel discussion with the topic taxation policy measure dealing with COVID-19 pandemic. On the panelists, we have Bapak Satrio Wibowo, the International Taxation Treaties and Cooperation Directorate of International Taxation DGT Indonesia. We also have Ms. Rieko Ueda, the Deloitte Partner Transfer Pricing, Japan National Leader. We also have Mr. Cam Smith, Deloitte Partner Transfer Pricing, Australia. And we also have Mr. Jerry Jian Wang, the Deloitte Partner Transfer Pricing, China. For the moderator, we have Mr. Roy Kian Tiong, Deloitte Southeast Asia Partner Transfer Pricing, Indonesia National Leader. Before we start the session, allow me to read the brief CV of Mr. Roy Kian Tiong. Roy is a partner in Deloitte Southeast Asia Jakarta office, and he leads Deloitte Indonesia Transfer Pricing practice. Roy has more than 20 years of experience in Indonesian domestic and cross-border tax as well as transfer pricing. And now we will let Mr. Roy to host the session.
Okay, thank you, Monica. Good afternoon, Honorable Professor Mardiasmo, Pak Yon Arsal, Pak Heru Pambudi, Professor John Hutagaul, Mr. Kisodial, BVD representative, and Mr. Audrey Orbach from OECD, as well as all English guests. So, ladies and gentlemen, it is an honor for me to moderate this session. So I hope that all of us in a safe and healthy condition in this challenging period due to the pandemic situation. So COVID-19 pandemic condition is a global catastrophe which affect all nations. Further, actually, the effect of the pandemic has gone beyond the matters of health, as it also affects the economy of all countries around the world. In this regard, we will be able to get some insight and summary on taxation policy measures in dealing with the current COVID-19 pandemic from our 4 major economies in the region, among others Indonesia, Japan, China, and Australia, which will be presented by our distinguished panelists from this country. So all these distinguished panelists have been introduced by Monica, our MC. So I will go through to introduce briefly on our first session background or CV, which is Pak Satrio Adribowo. So Pak Satrio is Section Head of International Taxation Agreement and Cooperation 1, Director General of Taxation of Indonesia. So Pak Satrio has more than 23 years of experience in taxation and has held other positions in DGT. He earned Bachelor of Economics from University of Indonesia, as well as Master of Art in Business and Commerce from KU. So I would like to hand over this session to Pak Satrio. Pak Satrio, the floor is yours.
Thank you, Pak Roy. The Honorable Professor Mardiasmo, President of the Institute of Indonesian Chartered Accountant, Bapak Yon Arsal, the Assistant of Minister for Tax Compliance, Bapak Heru Pambudi, Director General of Custom and Excise, Bapak John Hutagaol, the Director of Internal Taxation, Bapak Estu Yoga, the Director of Tax Dissemination Services and Public Relations, and also all the distinguished speakers and the participant of this conference. Assalamualaikum warahmatullahi wabarakatuh. Very good afternoon to all of you. And I wish all of us the health and strength to get through the pandemic situations. And in the session today, I would like to present my presentation. It's about the tax measures in tackling the COVID-19 pandemic in Indonesia. Next slide, please. So if you can see in the slides, this is the situation, the post and before the March 2020. So Indonesia reported the first cases of COVID-19 in March 2020, and afterward it spread widely in 34 provinces across the country. And so far, it's more than 300,000 cases has been confirmed in Indonesia. And this pandemic, it's affected not only the health sector, but also the other sector, especially business sector. And to overcome the situation that some provinces in Indonesia, such as in Jakarta, so it has decided to implement what's so-called large-scale social restrictions in order to minimize the spreads. So this pandemics will be influence the Indonesian economic growth. So the government have to intervene to ease the impact of the COVID-19. Next slide. So the COVID-19 pandemics adversely impacted economic growth in Indonesia. As you can see in the slides, the international institutions also already make some projection and revised projection, and this is the latest figures of the projection for the Indonesian economic growth. Is for the year 2020, it around 0 until -3.3. This is based on the data from the various institutions such as IMF, World Bank, ADB, and OECD. So this is very tough situation for the Indonesia. So the crisis impacting not only the supply side, production, goods and services, but also in demand sides, consumption and investments. And for the next slide. So in the situation, so what government should do there? So because the COVID-19 is negatively affecting all the sectors, so in this case, the role of the government, the government should take a part to intervene the situations. And in Indonesia, we have policies and program. We already have a national economic recovery. If you can see in the next slide. So the government intervention is essential to ease the burden for the society. You can see in the slide that Indonesia has taken numerous response to the COVID-19 pandemic, and we already launched a National Economic Recovery Program starting May 11, 2020, and the total budget allocated 695.2 trillion, and it consists of toward the 6 fields you can see in the screen. That's social protection, micro, small, and medium-sized enterprises, business incentives, ministry instruction, regional experiment, healthcare, and funding for corporates. So this is the measures taken by the government, and also the government regulation previously number 23 already amended by government regulation number 43 in this case. So the National Economic Recovery Program, not only in the 2020, but I still will continue in the next year, 2021, because the support still be required for the business to increase the competitiveness and the quality of human resource. And you can see, next slide, please. So regarding the tech incentives, the Indonesian government already allocated a total budget of for the tech incentives 123.01 trillion, and this is it's also been explained by Pak Yon earlier that it consists of several sectors and several aspects, such as a government income tax, also for the micro, small, and medium enterprise, also exemption of income tax Article 22, reduction of income tax Article 25, VAT preliminary funds, CIT reduction, and also other reserve and stimulus. So in dealing with the COVID-19 pandemic, Indonesian policy response, so it's emphasized on 3 aspects. I think first, protecting people health and also saving lives to provide health measures by providing health measures. And also we are trying to maintain the purchasing power by promoting such as social safety net. And one thing is also the preventing the bankruptcy by improving business support, including giving tax facilities and incentives. And for the detail of the tax incentives, you can see the next slide. This is the dynamic of a tax policy of Indonesian governments. You can see that in the first, we introduced the incentive in March 2020 by MOF regulation number 23. So from this slide, you can see that the tax incentives given to taxpayer affected by the COVID-19 crisis. So the tax incentives generally has 3 characteristics. So you can see that this is a temporary. If you can see that firstly regulated in the incentive durations until September 2020, and then extended to until December 2018. into 2020. And also it given selected and targeted ways, sectoral basis. And also the most important thing is it is flexible. So gradual adjustment based on the economic needs, extend the period and the scope of sector eligible. You can see for the MOF regulation number 23, just 440 type of industries and expanded to 1,189 of the industries. And the next slide. So the adjustment also, we make an adjustment in the reduction of income tax article 25 from previously just for from 30% to 50%, and also another incentive, income tax borne by government for construction companies will be included. So this is what I want to show you, that the regular review always carry out. So within several months, we adjusted the MOF regulations in order to accelerate the tax incentives to the taxpayers. And the next slide. And also, in addition to that, the tax incentives also been given to medical goods and services. Essential goods and services is very important to mitigate the COVID-19 pandemic. So we give the incentives for goods such as for the medicine, vaccine, etc., and also for the services. And regarding the flexibility, it's also been extended until December 2020 by the MOF regulation number 143, previously just until September 2020. So, and in this new MOF regulations, the Ministry of Finance allows pharmaceutical company to waive the VAT import for the tax component or other goods services related to fight the pandemic. And the next slide, please. And also, in addition to that, the government also give the income tax facilities in effort to mitigate the COVID-19. And this also this is explained by Pa Yon earlier. So we give an additional reduction in net income, 30% of the cost incurred for the domestic taxpayers who produce medical devices. And also the donation can be deducted from gross income. And also we give the additional income received by human resource for the health sector, the rate of 0%, and also income from the convention reimbursement subject to income tax rate at 0%. And the last the buyback shares traded on the stock exchange for the company. And the next slide. This is the regulation for the corporate income tax reductions. And for the year 2020 and 2021, the corporate income tax become 22%, and 2022 and beyond, it become 20%. And the government give an additional 3% of corporate tax rate reductions that was introduced for the company publicly listed in the Indonesian Stock Exchange as a part of the measures in response to COVID-19. So I think that would be the end of my presentation. Thank you very much. I give it back to you, Pak Roy. Thank you.
Yeah, thank you, Pak Satrio. It is a very interesting on the incentive that being provided by Indonesian government. It seems that it covers various type of tax, from employee income tax up to exemption of importation tax of Article 22, reduction of corporate tax installment, and I think the one which is very specifically focused incentive is given for essential goods, as well as the allowable of deduction on donation that being provided in order to attempt related to COVID-19 is a very good action and policies that issued by the Indonesian government. So thank you, Pak Satrio. I think we'll move to the next session, which is actually we will hear on the presentation from our major economic country in the region, which is Japan. So allow me to go to the next session, which actually will be presented by Ms. Rieko Ueda, and I would like to introduce Ms. Rieko Ueda. Ms. Rieko Ueda is a Deloitte Japan National Transfer Pricing Leader. She has an extensive experience in tax with focus in transfer pricing. She has assisted many clients in handling their transfer pricing matters, including assisting in advance pricing agreement with the National Tax Agency of Japan. Ms. Ueda graduated from Keio University Faculty of Law in the Department of Political Science. And I would like to also share that this presentation on Japan tax policy measures have been prepared in collaboration with Mr. Hiroki Yamakawa from Deloitte Japan. Mr. Yamakawa holds various positions in Deloitte Japan, including chairman of Deloitte Tax Japan. So Mr. Yamakawa has more than 38 years of experience in tax. Among those years, actually 30 years was spent with National Tax Authority of Japan, and with the last 6 years with Japan. So I would hand over the presentation to the next panelist. Ueda-san, please, the floor is yours.
Thank you, Roy-san. Thank you for the introduction. So my name is Rieko Ueda, the Japan National Leader for the Transfer Pricing Team in Japan. And as Roy-san has mentioned, that I have been preparing this slide with my senior advisor, Hiroki Yamakawa, who has been with the tax authority in Japan for a long time. So thank you again for letting me join the conference as a panelist today. And I'm very pleased to share the current situation from Japan. So next slide, please. So in Japan, the COVID-19 pandemic has definitely impacted the Japan in many ways. We didn't really have the strict lockdown of the city, but we have been trying to avoid the spread of the virus, staying home, not going to the office, and keeping social distance. So today I will share during my session that I will explain about the tax measures in Japan, and also discuss the effect to the international tax, especially for the transfer pricing taxation. So first, in this slide, I will explain an overview of the additional tax measures proposed as part of the COVID-19 pandemic in Japan. Basically, all of the measures are for domestic tax purpose, and international tax follows what has been applied for domestic tax. So the first one is the special provisions regarding the one-year tax payment deferral. In respect to the effect of COVID-19, all the taxpayers, both individuals and corporates, and regardless of size, satisfying certain conditions would be granted a tax payment deferral for 1 year. And that is done without the needs of the collateral, without the penalty or interest. And the tax payment deferral would cover all the national and local tax, except for the stamp tax, due between 1st February 2020 and 31st January 2021, and could be retroactively applied to already overdue unpaid taxes. So the conditions has been stated here that during any period of 1 month or more beginning after 1st February 2020, the taxpayers' revenue from business operations have decreased by approximately 20% or more. And also the condition is that the taxpayer has difficulty in making a lump sum tax payment. And the second one stated here is about the special provisions regarding the carryback of net operating losses in Japan. So for the corporations filing blue form tax returns, and the proposed would include a special carryback provision for certain corporations with stated capital not exceeding 1 billion Japanese yen. And normally, the carryback of net operating losses applies only for the small and medium-sized enterprise, but under the current situation, the caveat, the 1 billion Japanese yen capital, stated capital would be would apply for this special carryback provision. However, the proposed provision is not expected to apply to wholly owned subsidiaries of large companies, or corporation in which all issued shares are held by multiple large corporations within a 100% affiliated group. So the special carryback provision would apply to NOLs generated during the fiscal year ending between 1st February 2020 and 31st January 2022. Under the special provision, the net operating losses could be carried back to any fiscal year that being within 1 year prior to the first day of the fiscal year in which the NOL has been generated. And the measures that is stated on number 3, and I actually have 3 more in the next slides, are all the Japanese tax incentives that can be taken by the corporations. And number 3 is the telework investment incentives, where these incentives would allow the small and medium-sized enterprise an immediate 100% depreciation deduction or 7% credit on capital investment to support the telework and digitalization. To qualify for this, the purpose of the incentive, the investment must be for new assets related to domestic incentives, investments in production-related equipment, and be acquired as part of the plan approval by the Ministry of Economic Trade and Industry in Japan. Next slide, please. And number 4 is the special provision regarding the election of Japanese consumption taxpayer status. So this proposal would allow the taxpayer meeting the certain requirements to submit the Japanese consumption taxpayer status elections after the tax period begins, and withdraw an election during the following tax period. And usually the taxpayer has the filing deadline for the tax period that ends after the relevant legislation containing the proposal enter into force. But the taxpayer filed the Japanese consumption tax status election form by return filing deadline for the application tax period. And this might affect the cash tax payment of the Japanese consumption tax, whether or not it's applicable to pay the Japanese consumption tax or not. And moving on to the 5th point is the stamp tax exemption for the special loan contracts. The special loan contracts made by the public and private financial institutions to business affected by COVID-19 would be exempt from the stamp tax, and it would apply retroactively to certain business that already have concluded the special loan contract for which stamp tax has paid. And the last point is that the fixed asset tax reduction measures for the small and medium-sized enterprise, and decreasing the revenue for any 3-month period from February 2020 to October 2020 compared to the same period in the previous fiscal year, tax base reduction. Then for the certain taxpayers, those taxpayers impacted by the COVID-19, the tax base for the fixed asset tax and the city plan tax on depreciable assets and business use houses would be reduced. So these are the tax incentives, tax measures proposed as part of the COVID-19 pandemics in Japan. And as I mentioned, the most of the items were only for the domestic tax and was not directly impacted the international tax. But the international tax follows the same measurements as stated above. So moving on to the next slide, please. So in the next slide, I would like to share the current status of the tax audit in Japan under the COVID-19 pandemic. In Japan, since the pandemic occurred around February to March 2020 this year, the government has stated that a new tax audit has not started the new tax audit until there are reports requiring refunds or the statute of the limitation is approaching, which means they have stopped to start the new tax audit from the 2020 February and March. And unlike Indonesia, usually in Japan, the tax authority would perform the on-site tax audit, and they would actively visit taxpayer during the tax audit. But because of the COVID-19, they could not visit the client that often. They have stopped to start the new tax audit until September 2020. However, from the October 2020, tax office and the taxation bureau across the country has resumed a new on-site tax audit after confirming the taxpayer over the phone. And particular attention would be paid to the preventing of the COVID-19 during tax audit because still it will be done on site. But the fiscal year target to the subject to the tax audit is financial year ending March 2020 or earlier, which means they do have only minor impact of the COVID-19. So there are during the tax audit that has recently restarted in October 2020, the tax authority will be very careful with the COVID-19 when it comes to how they will do the tax audit. But they have prepared for it because they did have some time preparing for the tax audit. They have prepared than ever before, and taxpayers should be ready to discuss in deep from the start of the tax audit. They will try to reduce the number of the visits to the client, but they will make sure that they will do the discussion in deep with the taxpayers. And when the subject of the payment is found over the tax audit, the payment could be made slowly in light of the current situation of the cash flow. And in a study of whether the profitability of foreign entities should be lowered or not will be discussed for the considering the current situation of the COVID-19. Next slide, please. So future tax audit affected by the COVID-19 pandemic would only start from the August 2021. Because the tax filing of the affected year 2020 would be due during the summertime in 2021, the tax audit for those years would start after August 2021. And the tax audit for financial year 2020, which has been hit by COVID-19, as regards to the transfer pricing, the focus will be on how to keep the foreign subsidiaries within the arm's length profitability range. So even if the COVID-19 pandemic has affected, there is no instructions until now to lower the range or to make specific adjustment immediately. But the Japanese tax authority will be looking in detail of how it has affected that taxpayer and what special treatment would be taken into the consideration for that case. And one more thing is the organization of the tax authority in Japan has recently changed, and it has been rolled out in July this year that tax authority believes that the study focused on transfer pricing is no longer effective. They have reformed their tax authority to investigate the taxpayers' international tax, not only focusing onto the transfer pricing, but including all the international tax case. Moving on to the next slide, please. So under the current situation, what has been expected to, additional policy for COVID-19 in Japan is that for the time being, it is not expected that any additional tax measures will be released prior to the annual tax reform. So usually the annual tax reform the consideration would start during this time of the year. And the timing may change depending on the political situation, but usually around the middle of December, the ruling of the tax reform outline will be announced. And based on the contents of the tax reform, will be published by end of January to the middle of February next year. And it will be approved at the end of March, and the law will come into effect on April 1st. But as you may be aware, the Prime Minister Suga has taken the place as a Prime Minister, replacing the former Prime Minister Abe around last month's mid-September. So with this new administration in power, it is imagined that a comprehensive economic policy might be formulated and some policy would be presented. And if we look back the financial crisis back in 2008, 2009, measurements such as income expansion or employment expansion was taken in place. But during the current economic situation, it has been strict. The measurements has been really stricted. But now we could foresee that the measurements would be relaxed again, so that taxpayer would be able to apply for those type of measures. That is the end of my panelist discussion, and back to you, Roy-san. Thank you.
Thank you, Ueda-san, for explanation on the tax measures being given by NTA to its taxpayer. So interestingly, actually, seems that Japan already have some measures, but probably among others, it includes the deferment of tax payment and the carryback of the net operating losses, and it also provides for investment as incentive. In addition, also it will provide some relaxation in Japanese consumption tax, stamp duty, as well as reduction. But from the summary provided by Ueda-san, seems that the Japan NTA put a lot of focus to the small and medium enterprise, which is actually probably also cover a lot of the big chunk of the economy in Japan. So I think, interestingly, actually the tax audit have been relaxed during the COVID-19 condition, and probably will be started again in this period as of we are speaking, which is October. But of course, I think the interesting point on the last part, which actually shared by Ueda-san, with the changes of the administrative, we are about to see whether there will be changes in the tax policy or additional incentive being given or not. I think that concludes the overview of Japanese taxation measures policy. So in this, actually, we are going to cover another major economy in the region, which is China. So I'll go to the next presentation, which is actually tax measure policy in China. So the next presentation will be presented by Mr. Jerry Wang. He's a Deloitte China partner for tax and business advisory services. He is based in Suzhou, China. In Deloitte, actually, he handles transfer pricing, corporate tax, customs, as well as indirect tax. So Mr. Jerry has more than 24 years of experience, in which 20 years was with China State Taxation Administration, or STA. So during his tenure, he was also assigned as China Transfer Pricing Specialist with Her Majesty HMRC, which is UK tax authorities. And now he already joined in the last 4 years with Deloitte. Mr. Jerry graduated from Suzhou University College of Finance and Economy with major in accounting. So Jerry, actually, I hand over the presentation to you on the China tax measures policy.
Thanks, Roy. Good afternoon. This is Jerry Wang from Deloitte China. It's my privilege to give some tax sharing on the COVID-19 impact from China tax in the transfer pricing perspective. So for the next couple of minutes, I will walk you through the main tax relief issued by the China Tax Authority, the STA, to deal with COVID-19 pandemic, and also share some of our observation and insights on COVID-19 impact on tax and the transfer pricing practical environment, as well as the potential trend in China. At last, there is a summary of a current status of Chinese enterprises investing in Indonesia and the relevant measures taken by Chinese authority to boost such investment. And all right, let's kick off and please move to the next slides. Generally, in order to diminish the impact of COVID-19, China Tax Authority has developed much time and contributed to issuing and releasing relevant tax relief for Chinese taxpayers. For this section, we summarized the main tax reliefs issued in China, as well as some of the existing tax policies, which could potentially benefit the taxpayer severely affected by the pandemic in China. Shortly after the outbreak of the pandemic, China Tax Authority has made quick response through issuing tax relief in terms of enterprise income tax, value-added tax, individual income tax, and other minor taxes. In this slide, we summarize the tax relief for EIT. With respect to EIT exemption, STA stipulates new tax policy that qualifying financial subsidies from governments for epidemic prevention and control purposes will not be subject to EIT. Also, donation income received by qualifying nonprofit organization is exempt from EIT calculation. Other than direct EIT exemption, some existing tax policies as well as tax relief which has been issued after the outbreak of COVID-19 would benefit Chinese taxpayers in allowing more tax deductions. Specifically, Chinese company undertaking R&D function may apply for 75% super deduction of qualifying R&D expense based on the existing tax policy. That is to say, a total of 175% of qualifying R&D expense can be tax deductible, which substantially lower the taxable profit. Further, as stipulated by the recent tax relief, the cost of qualifying equipment for business manufacturing key supplies for epidemic prevention and control purposes may be immediately deductible rather than depreciated over the useful life. from the 1st of January through 31st December 2020. In addition, according to the current EIT law, Chinese taxpayers can make proper tax deduction on assets losses resulted from natural disaster, including disease outbreak. In order to further diminish the impact of COVID-19, STA extends the tax loss carry-forward period from 5 to 8 years for tax losses incurred in 2020 for business severely affected by the pandemic. Relevant industry include, but not limited to, transportation, catering, hospitality, travel, and the movie industry, etc. Also, before the pandemic, STA has released tax policy benefiting high and new technology enterprises in small and medium-sized technology enterprises whose tax loss carry-forward period may also be extended from 5 to 10 years. Next slide, please. Apart from tax relief for enterprise income tax, China Tax Authority also issued preferential policy regarding value-added tax. Specifically, some VAT taxable items become VAT exempt, includes free services provided to the general public for epidemic prevention and control purposes, epidemic prevention services by medical institutions, services to transport key emergency supplies, public transportation services, lifestyle services, etc. As you can see on this slide, for some items marked with a symbol of star, for instance, the services to transport key emergency supplies, public transportation services, etc., the exemption period will expire by the end of this year. For certain type of business in the transaction, taxpayer is allowed to apply for VAT refund. For example, any qualifying domestic R&D institutions in foreign invested R&D centers might apply for refunds of input VAT for the transaction of purchase equipment in China. Secondly, companies producing key supplies for epidemic prevention and control purposes might be able to claim refunds of any incremental utilized input VAT on a monthly basis. Such policy remains effective for the period from 1st of January to 31st of December 2020. Further, to boost export, the authority increased certain export refund rate for more than 1,000 types of products to 13% or 9%, starting from 20th of March 2020. Some examples of the product are certain types of fresh fruits, steel related materials, etc. Also, some beneficial tax policy was issued for small scale VAT payers. Specifically, for VAT payers in Hubei province, the VAT will not be collected during the period from the 1st of March to 31st of December 2020, while VAT rate is reduced from 3% to 1% in provinces other than Hubei for the same period. Next slide, please. With respect to individual income tax, the STA also grants exemptions for some items used to be taxable. For example, anyone who works for epidemic prevention and control purposes, such as the medical personnel, policemen, and other parties can apply for tax exempt on special subsidies, bonuses, and allowances received in FY 2020. For employees, any medicals and any medicines or medical and prevention supplies for prevention purposes provided by employers are also exempt from individual income tax in 2020. At the last, there are some there are some tax relief regarding minor tax, such as import tax, real estate tax, and the land use tax. To facilitate the import of relevant materials used for COVID-19 prevention and control purposes, any donation will be exempt from import tax. Also, tax relief on real estate tax and the land use tax can be claimed by the companies suffering losses or disruption on normal operation from the pandemic. Next slide, please. For next session, we will focus on the COVID-19's impact from China tax and transfer pricing perspective, as well as the potential trend in near future. Next slide. Firstly, it is foreseeable that there would be some delays in the process of APA and audit cases in China. For the first several months of COVID-19 outbreak, China Tax Authority, including STA and the regional tax bureaus, spent much time in making relevant research and analysis on potential impact on taxpayer, as well as formulating various types of tax relief. Later on, they were also occupied with providing facilitation on resumption of work and production of the companies. Therefore, it is observed that there was no substantial progress on existing APA and TP audit cases for last few months. At this particular time, we also see the condition that China Tax Authority has been recovering and back on track. So consequently, some cases would be moved forward recently. With respect to tax filing and the transfer pricing documentation compliance requirement, it was estimated that there could be extension on corresponding deadline for the first months of outbreak. Unexpectedly, as time approaching May, STA has announced that there will be no extension for FY 2019 EIT annual filing and preparation of TPT local file. Further, the requirement of preparing tax refunds, tax returns and the TPT remains unchanged as well. The COVID-19 pandemic also drives some companies to seek for certainty on tax result, considering the uncertain external environment affected by the disease. In this way, considering the fact that APA has advantage in providing taxation certainty and avoiding potential double taxation issues, such arrangement became more popular, and the number of companies which has the intention to apply for APA has increased significantly. Next slide, please. Based on our observation, Chinese government has made some movements in promoting foreign investment in the strengthening tax risk management program, in which potential trend can be estimated. In order to maintain existing foreign investment and promote incremental inbound investment, it is probable that Chinese tax authority will not have further aggressive movements so as to provide buffer time and let companies recover from the pandemic. To further attract foreign investment, the authorities, for example, the Ministry of Commerce, has been continuously issuing preferential policy, as well as improving its capability to serve relevant companies. Although there could be no aggressive movements, STA and the local tax bureaus have been focusing on the establishment and the strengthening the TP risk management pilot program. Recently, in August and September, more provincial tax authorities issued a notice to companies within its jurisdiction to introduce such framework, which make another round of information collection to enrich the company pool for monitoring and the risk management. In practice, we have many clients approaching us to seek for our suggestions for the providing relevant information required considering the higher and strict requirements from the tax bureau. Next slide, please. As promotion and implementation of One Belt and One Road initiative, we observe the condition that more Chinese enterprises choose to make investment in Southeast Asian countries, including Indonesia. In recent years, Chinese companies are encouraged to make investment in relevant foreign countries, which is guided by One Belt and One Road initiative, as just said. Another important factor which should be taken into account is the high operating cost in China. Labor and other costs, such as land, rent, etc., in China has been soaring from time to time and appears to be relatively higher than Southeast Asian countries like Indonesia. In this way, many Chinese companies choose to relocate their global supply chain and move the manufacturing facility into Southeast Asian countries, including Indonesia. As a result, it is observed that more Chinese companies has invested in Indonesia by acquisition or by setting up new companies. In order to facilitate and smoothen Chinese companies' investment in Indonesia, the Chinese embassy in Indonesia has been continuously providing relevant assistance where needed. Also, the Chinese tax authority, the STA, has issued guidance on investment in Indonesia and summarized all relevant tax laws and regulations so as to provide a general picture of tax system in Indonesia and better serve the Chinese taxpayers. Yeah, with this, I'm going to the end of my sharing. Thanks.
Thank you, Mr. Jerry, actually on sharing on your insight for the tax policy introduced by China ICT. So interestingly about China, actually a lot of incentive being given in a lot of type of taxes that includes enterprise income taxes, a super deduction in form of super deduction and exemption of taxable income, extension of taxable carried forward, and actually it also provide some exemptions on item, which is I think this one is being provided to handle the pandemic situation, because I think mostly it is being given to essential goods, which is relevant to the pandemic situation. So it seems that also similar that what we've seen in other countries for small and medium enterprise, they also get some attention from the government, I think because they also heavily affected by this condition. Interestingly, being shared by Mr. Jerry, actually, because of this pandemic impact, actually some delay of the audit have been applied. And I think there also will be some relaxation, but I think this, the good things does not make the Chinese government or China ICT to hold the investment in other country. So actually a promotion of the investment to our country, including Indonesia, still continues, and which is actually supported by the embassy. So hopefully this also will also have a good impact on Indonesian economy. I think that would be the summary of Mr. Jerry's presentation. So next we will go to the last major economy in today's session, which is Australia. So this session will be presented by Cam Smith. Cam Smith is a Deloitte Australia partner. He is based in Melbourne with 25 years in transfer pricing as well as international tax, by working in various regions, including Australia, Asia, and Europe. So Cam has assisted clients from various industries, and cover in a lot of cases, including transfer pricing policy, value chain, as well as discussion with authorities in bilateral or unilateral APA. Cam graduated from University of Tasmania and has a combined honors degree in law and commerce. So Cam, thank you for your time. So the floor is yours.
Right, terima kasih Roy, and selamat siang everybody. It's very nice to be here with you all today. I wanted to cover 4 principal aspects of Australia's tax responses to COVID-19 today. They're listed on the slide here. So firstly, I wanted to discuss the Australian government's response to COVID-19 in relation to the key budgetary measures which have been implemented so far, and also in relation to Australia's 2021 year federal budget, which is being announced right now. In fact, our government treasurer started delivering the federal budget in Parliament about 1 minute ago. So I'll talk you through what new COVID-19 tax measures the government has already announced will be included in tonight's budget. But unfortunately, I can't watch the television and repeat what's being promised as the treasurer speaks. Secondly, I really wanted to discuss the Australian Taxation Office response to COVID-19. I thought that might be of interest to our audience. And on that front, I wanted to talk about what practical measures in tax collection and in tax compliance activity the ATO has been engaged in, and also just talk briefly about some guidance they've issued on tax and COVID-19. The next slide, please. Great, thank you. All right, so we'll start off talking about the Australian government's initial tax policy responses to COVID-19. And we have to bear in mind that the initial responses in the early stages of the virus were made when the health and economic outlooks were at their bleakest. So we're looking back to March and April 2020. I think the Australian government considered it necessary at that time to provide lifelines to both individuals and businesses so that Australia still had the building blocks in place to take advantage of what's expected to be a very long and very slow economic recovery. So the government's initial response was based on a few fundamental principles. Firstly, the government went really hard and really fast, trying to solve problems on the run, and with speed being preferred in relation to its initiatives over elegance. So, for example, the JobKeeper law, which we'll discuss in a minute, was developed and passed by the Australian Parliament very quickly, with the detailed process of administering the scheme, guidance on complex issues and tweaks to the rules, all following over the first few weeks of the program. Secondly, the government used existing systems, existing infrastructure to deliver the support that it wanted to provide. And in that regard, the Australian Taxation Office's administration machine was called into action to roll out the JobKeeper program using existing ATO systems for employers. I think the government just thought that that was the quickest way to get things out by using existing infrastructure. And I think that was, in hindsight, that's been quite a clever approach. Thirdly, the government designed solutions which are practical, pragmatic, empathetic, and as simple as possible. And a few examples of those were things that we've seen around tax compliance approaches and shortcuts around employee home office expenses, given we've all been working from home for the last 6 months, and practical tax positions for employees who were trapped across borders. Those were a few examples of those. And fourthly, the government's solutions were scalable so that the various measures could all be ramped up or dialed back down if necessary. And then a good example of that is eligible periods for particular measures like JobKeeper can be and have been actually extended, and also the relevant amounts payable can be increased or decreased as the government sees fit. So in terms of the tax policy perspective, the Australian government's initial responses focused on reducing the risks associated with income, liquidity and solvency. The key measures introduced were those that we've listed on the table on screen. I do want to go through a couple of them, but I won't go through all of them today, or perhaps we'll just focus on the most important ones. If we start with income support, and perhaps the most important measure on that front was our JobKeeper payment scheme. And I guess like many countries around the world, Australia introduced a wage subsidy scheme, which we've called JobKeeper. That JobKeeper payment regime has two main objectives. Firstly, to help businesses affected by the coronavirus to cover the costs of their employees' wages so that more employees could retain their jobs and continue to earn an income, and then I guess continue to spend that to keep the economy going. And secondly, to ensure that employees and employers maintain their connection, allowing employers to hold on to workers' talent and experience so that the subsequent economic recovery would be stronger and faster. I think if we look back at what JobKeeper has achieved with the payments covering more than 3 million Australian employees, the schemes proved to be a really significant contributor to employment stability and workplace connection. I might just say that 3 million Australian employees is quite a significant part of our overall population. We only have 25 million people. I know that's a bit of a drop in the ocean compared to Indonesia, but in an Australian context, that's quite significant. Now that JobKeeper payment's been extended until the 28th of March 2021. And I think, again, that's a really good idea. Also, we have a job seeker system, which is for people who are out of work and looking for work. The government temporarily expanded eligibility for that job seeker payment scheme and also doubled the amount of payments made, again, just to keep cash flowing through into the economy to keep things going. If we look at the liquidity tax policy objective, there's a number of measures there. The government boosted cash flow for employers. And on that front, eligible businesses with annual turnover under $50 million were provided with tax-free cash flow boosts of between $20,000 and $100,000. There was the early release of superannuation. So Australia has a pension scheme, which we call superannuation. And so individuals who are severely and adversely financially affected by the coronavirus were able to access up to $10,000 of their pension fund early. Otherwise, they would normally have had to wait until they retire before being able to access those funds. There were a number of state government concessions introduced, principally around the reduction or the waiver of payroll tax liabilities for the 2020 financial year for smaller businesses. And also a number of state government grants were provided to businesses which were highly affected by the COVID shutdown. So businesses in industries like tourism, like hospitality, which were really hard hit by the reduction in people's ability to move around the country. On the stimulus front, there were investment stimulus, a couple of things there. Businesses with turnover under $500 million can claim immediate tax deductions for new and second-hand eligible assets acquired and ready for use before 30 June 2020, where those assets have a value of $150,000 or less. And for all other new eligible assets that are installed or ready for use in the years ended 30 June 2020 or 21, an immediate deduction of 50% of the asset's cost is available. So some good tax incentives there. There were a regional and community support fund offered by the government. So $1 billion Australian dollars was allocated by the government to support sectors, regions and communities that have been disproportionately affected by the economic impacts of COVID-19, including those heavily reliant on industries such as tourism, agriculture and education. So the Australian government's tax policy response was pretty quick and pretty hard, and with a view to protecting businesses and individuals through the early stages of the economic fallout from COVID-19. And I think so far that's been, they've done a pretty good job. But we'll see what happens in the budget tonight as to what further measures there might be. Next slide, please. All right, now we've looked at the government's response to COVID-19. Let's have a look at what the Australian Taxation Office did to support business. And maybe just as an initial comment, I have to say I've been really impressed by the way the ATO has supported businesses and supported individuals over the last 6 months or so. They've been as supportive as they can and as practical as they can, and they've implemented a number of initiatives to help taxpayers, which we'll just talk quickly about now. So I guess Australia regularly experiences natural disasters, and so I guess we've already got some standard solutions in place that could readily be rolled out in response to COVID-19. And so tax administration relief measures, which are typically used for things like bushfires and droughts in Australia, have provided some regulatory and cash flow support, and they've been rolled out relatively quickly as well. The main ones are those listed on screen. So there have been some tax return lodgement and tax payment deferrals, some on a case-by-case basis, which taxpayers have to request, and others on a general basis. The ATO's provided extra time for taxpayers to pay debts without incurring any interest charges. They've prioritised the processing and payment of refunds to taxpayers. They've remitted interest and penalties incurred on or after the 23rd of January 2020 that have been applied to taxpayers' tax liabilities. They've deferred certain tax compliance activities. So as I mentioned earlier, a lot of ATO staff were required to work in the JobKeeper program. And so a lot of the case officers that we were seeing working on tax reviews and tax audits were actually moved off case teams and moved into the JobKeeper program. And so the compliance activities that they were working on had to be deferred. And also the ATO has allowed individual taxpayers to vary their pay-as-you-go instalments if they anticipate that they'll be earning lower levels of taxable income this year compared to last. So again, the ATO has been very supportive. Next slide, please. Okay, given I'm a transfer pricing partner, I just wanted to talk quickly about some guidance that the ATO has released in relation to transfer pricing aspects of COVID-19. And I wanted to do that because I think the guidance that they've released is pretty consistent with the views of what a lot of tax authorities around the globe would have in relation to transfer pricing and COVID-19. And I say that because I guess the pandemic has really forced or really accelerated changes to taxpayers' supply chains for a number of reasons. And I think tax authorities are potentially concerned about the impact or the adverse impact on their tax revenue bases as a result of those changes. So I think it's really important at the moment that taxpayers do pull together contemporaneous documentation around particularly around the commercial rationale for the reasons for changing their supply chains and the impacts that it has on their operations in local jurisdictions and also the pricing of their international related party arrangements. So I think with that in mind, the ATO has released a couple of pieces of guidance. One, which helps taxpayers think about what sort of things they should include in their transfer pricing documentation for 2020. What sort of evidence they should collate to support any changes to their local businesses as a result of the pandemic. And those are set out on the slide. So the ATO would like to see things like changes in functions, assets and risks, changes to contractual arrangements, changes in business strategies, and most importantly, perhaps, detailed impacts of COVID-19 on the profit and loss, and maybe looking at what the budget was before the pandemic hit for 2020 compared to what actual results were achieved. Next slide, please. So in a similar sort of way, as I was mentioning, the COVID-19 has really accelerated changes to supply chains. And the ATO has indicated that it's going to closely review changes to taxpayers' related party arrangements to assess whether or not independent parties in comparable circumstances would have agreed to change the status quo and enter into terms or conditions consistent with the new related party arrangements. As always, tax authorities are interested in substance versus form, and so they'll review whether the substance of new arrangements are actually consistent with the new contractual arrangements. And they'll really look hard at the justification or the commercial justification for the new arrangements. Okay, next slide, please. Okay. I just want to talk quickly about what new tax measures are expected from the Australian government in response to COVID-19 in this year's budget. So I think this year's budget promises to give Australians and our businesses a really big spending hit to get the economy out of its deep recession that it's currently undergoing. The budget's also planned to continue the defence of our livelihoods, our employment, but also to gradually change gear from protecting old jobs towards creating new jobs in the industries of the future. The key measures expected in the budget are focused on fast-tracked individual tax cuts, which are set to put billions of dollars into the pockets of Australian workers. Secondly, that the budget's really going to be heavily focused on getting people back to work. There's a lot of people out of work at the moment, and the economy really can't start to get going unless they really return to employment. And thirdly, that the government seems to have abandoned any near-term plans to return the budget to surplus, with a record deficit expected to be unveiled, and also future forecasts for the next 3 to 4 years also showing deficits as well. So if we look at some of the expected budget announcements listed on screen, just very quickly, as I said, the government's likely to bring forward some planned personal tax cuts to the 1st of July 2020, so they'll backdate those, and they were originally due to start in 2024. So again, trying to get boost to workers' pockets by cramming tax cuts into the remaining 8 months of this financial year. There'll be tax loss carryback benefits, which will allow small businesses to offset current losses against previously paid taxes in order to boost their cash flow. In relation to research and development tax breaks, the government had proposed to around $1.8 billion in cuts to the R&D tax break, but there's a sense that the government might reverse some or all of that in tonight's budget. There'll be stimulus through the investment allowance. The government hasn't provided any details on that, what that might be, but Big Business has said that it wants a 20% write-off with no limitation on the size of companies that can claim the concession. So we'll wait to see what the government says on that front. Small business startups will get tax breaks. There'll be fringe benefits tax breaks for training. There'll be income tax deductions for retraining. So the government's going to consult on changes to existing rules that deny people from claiming tax deductions for the cost of training for a future career. I think that's a good move. And in relation to superannuation, there's speculation as to whether the government will reverse the proposed increase in the superannuation guarantee from 9.5% of salary and wages to 12% over the next few years. Next slide, please. And this is my last slide before I hand back to you, Roy. So these measures are really stimulatory measures. They're not necessarily tax measures, so I won't go into them in detail, but there's obviously a whole raft of measures that the government's thinking about implementing just to really drive the economy forward and to stimulate the economy in a better way. Okay, back to you, Roy. Thank you.
Thank you, Cam, for your explanation. Seems that Australia have a lot of stimulus and incentive. Well, actually, to summarize, it seems that in the initial response, they focus on stimulus with focusing in income support, liquidity, solvency, as well as stimulus. And they provide also relaxation on the compliance, acceleration of refund, as well as remission of any tax interest penalty. The interesting part, actually, as a transfer pricing practitioner, the Australian government issued a specific and focused policy regarding to the transfer pricing arrangement, which is things that we need to look forward in all other countries, because as you know, that this current condition actually affected a lot of companies. So I think that there is my summary of presentation for Australia. So I will go to the next session, which is Q&A. So let me check. We have one question, which is addressed to Pak Satrio. So Pak Satrio, actually there is a question, but it is being placed by anonymous attendee. So the question is, in Indonesia, for the implementation of tax audit, can the tax audit being postponed? I assume this is related to the current condition of pandemic. If the tax audit are still carried out, whether a payment delay of payment can be given without being subject to additional sanctions. Businesses have been affected by the current COVID-19 pandemic. Although historically their performance has been good, to make current policy for their previous performance with pandemic conditions very burdensome for the entrepreneurs. There is the first question. Probably before we go to the second question, Pak Satrio, will you take this question?
Okay, thank you very much, Pak Roy. Thank you for the questions. So I would like to answer the question. So first, the tax audit, it can be postponed first, or payment can be delayed, and the second is tax losses carry forward can be extended. So currently is not possible, Pak Roy. So, but we are still conducting tax audit. But at the moment, by the new protocol, so we encourage the communication by telephones or email in the process of tax audit. But about the postponing the tax audit and extending the losses carry forward is not possible at the moment. The new protocol also for the tax audit closing meetings in Indonesia should be conducted via video or teleconference where it's possible. So I think that's my question, Pak Roy. Thank you.
Thank you, Pak Satrio, for the answer. There is another question from the same person. Quickly, the tax losses carry forward can be extended from 5 years to 8 years because of the possibly. I think the question: can the tax loss carry forward can be extended from 5 years to 8 years because COVID-19 pandemic condition? As currently most of the companies are losing money and cannot take the advantage of the existing tax losses. Pak Satrio?
Yeah. The answer is still the same, Pak. It's not currently it's not possible to extend the losses carry forward.
Okay, so I hope that explanation provided a clear answer to the question being raised. I think because there is no other question, I would like to raise question to Ueda-san with regards to Japan. Actually, in one of your discussion, you mentioned that Japan is one of the major powerhouse in this region and it has a lot of investment. So out of my curiosity, actually, what are the Japan companies' reaction to the current COVID-19 condition so far with regards to its transfer pricing policy with its overseas subsidiary, because Indonesia have a lot of Japanese investment. So this will be very interesting questions. Ueda-san, I think I give it to you.
Thank you, Roy-san. I agree that Japan headquartered company a lot of invested into the Indonesia. And currently we have been discussing carefully with the Japanese headquartered company about the impact of the COVID-19 to the foreign subsidiaries. So the Japan usually have the March year end. So the current year started from the April 1st, which has been severe hit by the COVID-19. But because they do have a lot of operations outside of Japan, the Japanese headquarters is carefully assessing the impact in each country, analyzing the impact of the COVID-19, as well as the impact of the arm's length range of the transfer pricing policy that currently have. So currently the National Tax Agency, which is the tax authority in Japan, has not given us the clear guidance of what measurements or what special adjustment can be taken by the tax authority, but they are willing to discuss with the taxpayer if there is any specific impact to their operations outside of Japan. So in case of they do have the bilateral APA in place, the taxpayer has been actively discussing with the tax authority in Japan what has been impacted into their business. And they have been discussing what the special adjustment or special analysis can be made to that effect. So that currently the Japanese headquarters is collecting all the information, and they will be making sure what would be the measures that they will take for the December year end or the March year end next year.
Thank you for the explanation, Widasan. So interestingly, I think the suggestion, the NTA is aware on the impact, although there have not been a very fixed policy. It seems that they are monitoring, and actually discussion is suggested for the taxpayer. Thank you. So with that, I will go to the next region, which is China. I think the interesting point that being covered in the previous presentation is about the APA as well as audit delay. So far with the delay, actually, what is the China STA potential attitude? Because I think on one hand, I think there is a delay in the process of audit, but on the other hand, I think a lot of company will need to revisit or actually will also file an application for APA in the future, actually, because I think they expect this current condition may prevail in the near future. So Jerry, probably can you share your view on that one?
Okay, thanks, Ro. In recent years, we observed that, in terms both number of companies who have applied either unilateral or bilateral APA has been increased substantially, and also the number of cases that has been successfully negotiated has also increased. For those kind of information, you can find in an annual book issued by the STA. Practically, it is possible that Chinese tax authority would have an open and positive attitude, and would encourage taxpayers to make either a unilateral APA or bilateral APA applications, especially due to that the authority has been released from handling the pandemic and would have more time and more personnel in dealing with such application. As required by the central government, all government authorities have been making their contribution to create a favorable investment environment for the companies. And so STA has considering that the application and negotiating of unilateral and bilateral APA as a good way to effectively eliminate potential double taxation issue and to create tax certainty for the companies. Yeah, right.
Okay, thank you for sharing. It is quite interesting and relieving that although there have been some delay, but the negotiation is still on with, of course, I think the potential focus that to avoid double taxation for the companies as well as its subsidiaries. Thank you, Jerry, for the explanation. So, I think, so I think I have one question from the attendees to Cam Smith. So probably Cam, I think I will address it to you about the tightening foreign investment policy from the Australian government. So do you have any detailed rules about this policy? So what are the differences between the previous policy and this upcoming COVID-19 rules? So thank you, Cam. So I will hand it out to you.
Yeah, sure, no problem at all. So I think the new rules came in at the end of March this year, and broadly, all foreign investments are now subject to the Foreign Acquisition and Takeovers Act, regardless of the size of the transaction or the nature of the foreign investor. So they will now all be subject to Foreign Investment Review Board review and approval. So a couple of key points to note there in terms of the differences between the old rules and the new rules. So the monetary thresholds for all foreign investment proposals is reduced to $0 now. So there were a number of different thresholds before. That the main one was for an acquisition by a privately owned foreign investor of 20% or more of an interest in an Australian entity. The previous threshold was above 275 million Australian dollars. So now that's effectively been reduced to $0. And the second rule, which could be considered to be a tightening of the old rules, is that the Foreign Investment Review Board timeframe for review and processing is now, it's been extended from 30 days to 6 months to ensure that there's sufficient time for screening relevant applications. So I think the government, it has tightened the rules, but it's also tried to make it very clear that it's not intending to freeze foreign investments. Australia is still open for business, and foreign investors can still make acquisitions of Australian assets. So the intention isn't to block foreign investments, but I think what they're saying is that they're trying to protect normally viable but now very vulnerable Australian businesses, which would ordinarily be sold to foreign investors without any government oversight. And so I guess they're just trying to protect the national interest. Hopefully that answers the question.
Thank you, Kem, for sharing your answer and insight. So, ladies and gentlemen, actually, it has been a very interesting session because we can hear actually the tax policy that being issued by Indonesia as well as other countries. But due to, I understand that there are some questions that have not been able to be discussed, but because we are slightly in the schedule, I would like to summarize and close the session. So basically, thank you to all of the speakers for your insight. To sum up, actually, we can see that all governments have something in common with regards to this current pandemic condition. There is an effort to harness the hardship of the current pandemic condition for all the business community as well as taxpayer. So directed at its business community and taxpayer, the intention is the economy will be able to thrive again in the future. So we can see a lot of incentive and initiative, which is more or less similar, but of course with slightly modification in Australia because it is policy which we expect or we hope that the same policy can be followed in other jurisdiction and country. With that, I will conclude this session. Thanks again, and I hand over the floor to Ms. Monica. Thank you, everybody. Have a good day and be safe and be healthy.
Thank you, Mr. Roy. Perhaps we will take a group picture on the panel discussion 1. So, Bapak Satrio, Ms. Rieko, Mr. Kem Smith, Mr. Jerry Jiang Wong, and Mr. Roy, please to turn on your video. Okay, thank you. Thank you for the fruitful discussion. Ladies and gentlemen, now we have the panel discussion 2. The speakers for this session are Bapak Arnaldo Purba, Section Chief of Exchange of Information 1, Directorate of International Taxation, DGT Indonesia. We also have Mr. Andrew Orbach, Senior Tax Advisor, Center for Tax Policy and Administration OECD Jakarta Office. We also have Bapak Janurindro Wibowo, Head of Sub-Directorate of Import, Directorate General Custom and Excise. Also, we have Mr. Louis Carrillo, Senior Director for Tax Transfer Pricing Solution, BVD, a Moody's Analytic company. For the moderator, we have Bapak Bagus Arianto, Section Head of Audit Execution, IIC, Directorate General Custom and Excise. So for the speakers and the moderator, welcome. I would like,
thank you.
yeah, before
Thank you very much.
Bapak Bagus host the session, I would like to read a brief CV. Bapak Bagus Arianto currently active as a state civil apparatus at the Directorate General of Custom and Excise, Ministry of Finance, with his last position as section head of audit implementation. So now we let Bapak Bagus to host the session.
Okay, thank you, Monica, for the opportunity. His Excellency, the Chairman of Indonesia Institute of Chartered Accountant, Professor Mardiasmo, Honorable Director General of Custom and Excise, Mr. Heru Pambudi, Honorable Assistant Minister of Finance for Tax Compliance, Mr. Yon Arsal, Chairman of Tax Accountant Compartment, the Indonesia Institute of Chartered Accountant, Professor John Huta Gaul. Good afternoon, Prof. The Director of Center for Taxation Policy and Administration OECD, Mr. Pascal Sain-Amans, Managing Director of Bureau van Dijk, Mr. Kisodial, distinguished resource persons, moderators, and all the participants of Indonesia International Tax Conference 2020. Assalamualaikum warahmatullahi wabarakatuh. Good morning, good afternoon, good evening to all of you. Today, I'm truly delighted of this pandemic, the Indonesia Institute of Chartered Accountant, Tax Accountant Compartment, and Bureau van Dijk still make an excellent arrangement for the International Tax Conference 2020 event. We have almost 500 participants here joining our first virtual International Tax Conference by Zoom webinar application. And some other participants are watching this conference by streaming ICA YouTube channel. Ladies and gentlemen, striving this COVID-19 pandemic, I hope you all safe, your family all safe, keep healthy and strong coping this difficult condition. And in the next hour, I, Bagus Arianto, will guide you as your moderator through discussion with an interesting topic, the taxation matters arising from digitalization. This is a very interesting topic. Whether we want it or not, almost all aspects of our life have shifted from manual to automation or digitalization. We are simply relying ourselves on our gadget today. We are having our daily tasks and communication through this device. We choose our lunch only by clicking a delivery application in our smartphone and pay it with our digital currency. We can also buy something not only from our country, but also from other countries just by relying on the strength of our finger and of our money, of course. No need for extra effort. Just sit back and relax. Your goods will be arrive at your door. Moreover, now you can play music or hear some podcast on your Spotify, watch your film in Netflix, make your exercise by watching YouTube channel. Simple as that. How technology and digitalization make our life easier today. With this pandemic, the demand for digitalization are even increasing. Today, we need to reduce the physical contact in order to follow the health protocols. Every meeting is held online. Our children also learn our school from home by daring or virtual application. Zoom, like we attend now, a Google Meet, Microsoft Teams, Skype, are mandatory applications installed in our gadget. One of the impact is the significant growth of digital service provider. As we know, the founder of Zoom, Eric Yuan, for example, has become one of the richest men in the world with his net worth approximately $19.4 million US. With this panel, we want to discuss taxation matters arising from digitalization and how custom and tax authority Indonesia Custom and Tax Authority take this opportunity to increase their state revenue from digitalization, and how OECD and BVD perspective for that case. Ladies and gentlemen, I don't want to linger because we only have limited time. And now we have 4 distinguished panelists join us to address the topic. Please welcome Mr. Janurindro from DGCE, Mr. Arnaldo Burba from DGT, Mr. Andrew Orba from OECD, and Mr. Luis Carrillo from BVD. Please give applause to all panelists today. All panelists in this discussion will have around 10 until 15-minute presentation, one by one, starting with Mr. Janurindro, and then Mr. Arnaldo Burba, Mr. Andrew, and Mr. Carrillo. And after all the panelists give their presentation, I will start Q&A session. For the participant during this discussion, if you have any question, please type your question only in Q&A box, and I will choose and read it later. Don't forget to mention your name, your institution, and to whom your question addressed. Okay, the first panelist from government agency, we have Mr. Janurindro Wibowo from Directorate General of Custom and Excise, the same institution with me. Good afternoon, Mr. Janur.
Good afternoon, Mr. Bagus. Thank you.
Siap. Mr. Janur, current position is Head of Sub-Directorate of Import, Directorate of Custom Technique, DGCE. His previous position was the Head of Custom and Excise, Office of Cikarang, West Java. His interest in e-commerce and digitalization area began when he attended the regional workshop on digital custom and e-commerce for WTO Asia Pacific region in 2016. Mr. Janurindro Wibowo holds a Magister in Technique from Bandung Institute of Technology in 1998. Ladies and gentlemen, without any further ado, please welcome Mr. Janur. Mr. Janur, the floor is yours.
Thank you. Good afternoon, audience. Assalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam.
In this presentation, I would like to share a topic about challenges that are faced by custom related with the rapid development of digital economy in the world, and conduct justice policy from digitalization. Next slide. First of all, there are many factors that contribute to develop of digital economy: the rise of internet, the invention of cloud computing and big data, and utilization of financial technology and other new digital technology. Next. E-commerce, one of issues in digital economy. OECD define e-commerce as the share or purchase of goods or services conducting over computer network by method specially designed for the purpose or receiving or pleasing of others. There are two types of trade in e-commerce: tangible and intangible or digital goods. The type of good that being transacted now is not only tangible goods but also digital. The goods that previously or traditionally traded in physical form, such as books, music, software, are now more commonly distributed in their digital form through electronic transmission to trade wide available. Therefore, the challenges related to the digital economy could also be distinguished into challenges in tangible goods commerce and digital goods commerce. Next slide. This slide gives an example illustration regarding the shifting that exists in era of digital disruption. Previously, people reading news and many other information that happen around them from newspaper or magazine or books, which they need to buy first. But now they can get same information faster, cheaper using one device called cellular phone, which connected to the internet. This is shifting. Next slide. What custom organization have a definition of digital goods? Digital goods means computer program, text, video, image, sound recording, and other products that are digitally encoded, regardless of whether they are fixed or carrier medium or transmitted electronically. Meanwhile, trade in intangible goods could be described as the transfer of product electronically, digitally. However, there are still ongoing debate as to whether trade in intangible goods or digital trade is categorized as trade in goods or trade in services. This is more difficult define. Next. But software, text, and etc. This is have a characteristic of good. Here state that's a 5 essential characteristic of goods. Goods are entities which over ownership, can possess. Goods have a value used for reproduction, consumption, ownership, transferable, have economic unit, must be inventory. Goods have a characteristic from taken natural and delivered, copied, and etc. So software is a goods by definition here in 1999. Next slide. Next slide. In digital economy, e-commerce also shift many things from vessel to drone, payment from big note to digital currency, fintech, financial technology, and etc. Transaction. Previously, we buy something with conventional shopping, but no online shopping, delivery, and the in terms of resources, nowadays, gold, oil is not more valuable between data. McKinsey Global Institute suggests that showing cross-border data flow now generate more economic value than traditional flow of trade goods. So data is more valuable than gold. Next slide. This slide describe comparison between physical and in the top and digital goods at the below. In physical goods, there are port of loading, port of destination. There are transporter, means of vessel, and there are goods in a container. Similar with physical and digital good, there are any sender and receiver. there are any transporter. This is electronic transmission. And content. Content is similar with goods. Okay, next slide. As we know, World Trade Organization still moratorium on custom duty on electronic transmission since 1998 until now. Member of with WTO agreed to maintain the current practice, not imposing custom duty until the next session WTO Ministerial Conference meeting. A debate still exists whether the moratorium applies only the electronic transmission and not to product and content which are submitted electronically. There is still no consensus about the matter, content and electronic transmission. Next slide. So Indonesia believes that moratorium should not be permanent in order to provide a policy space for economic, since the issue is not related to revenue, but also goes beyond a trade statistic, level playing field, and state sovereignty. Also, it's believed that e-commerce and digital economy will shape the global trade in the future, so the discussion regarding e-commerce should provide a flexibility. And the next slide, we have a study of from UNTOUCH. UNTOUCH state that UNTOUCH state that estimate that import value of 49 product is similar physical product to digital product. In 2017 should reach until 255 billion US dollar. It's very, very big. The difference between estimate value and actual value is a total import. This slide is from UNTOUCH research that's 255 billion US dollar transaction for from LDP, mostly from LDP, is not recorded. Next slide. The detail from the tables show that using bond rate, the potential tariff revenue loss to developing country estimate until 10 billion US dollar. It's very, very big since 1998 moratorium electronic transmission. Okay, next slide. So UNTOUCH calculated, estimate the loss from Indonesia revenue until 54.1 million per year US dollar, mostly from 3D printing. And my team, next slide, have calculation potential value of digital goods transaction in Indonesia. There are 151.73 trillion rupiah. Activity in digital goods is not recorded, not regulated. There are software, movie, game, and etc. Okay. Next slide. Next slide. state in the slide, Indonesia has included the tariff and classification of digital goods. We divide digital goods in 1, 2, 3, 4, 5 classification and give zero burden import duty, still zero, which regulated in Minister Finance number 17. Digital goods transmitted electronic include in chapter 99, regulate in this chapter. We divide two activity, software and other digital transmitted electronically refer to heading 99.10 those are not related to machinery or device that have been or been will be imported. Note 1 is if you import machinery and software refer to, this is go to HS number machinery, but if related goes to HS number 99, chapter 99. Next slide. So what's the reason to regulate digital goods? First, the regulation will help government to record the trade statistic in order to get information regarding trade balance, type of digital goods, supplier, and many others. By regulating it, there will be a creation a level playing field, for instance, between conventional and online, domestic, foreign company, small and big company. We should encourage small medium enterprise because activity in domestic small medium SME pay the taxation, and so cross border I think is no pay duty, no pay income tax and extra. And then the regulation will also create a certainty in terms of duty and tax, not only for government, but also business in terms of declaration. And the last, digital risk, avoid tax avoidance, IPR, transnational crime, and etc. Next slide. Okay. All in all, in facing the challenging to rapid development of digital economy, government need to cooperate in order to make regulation that ensure the creation of level playing field, improve the transparency, and enhance the law certainty. Thank you.
Thanks for your great presentation, Mr. Janur. You already explained to us the definition of digital goods, including software, TV transmission, and etc. And the potential value of digital goods transaction in Indonesia, and the update from WTO regarding moratorium on custom duties on digital goods. It is very interesting for us to have further discussion. Okay, now we will have our second panelist. Our second panelist came from Government Agency 2 from Directorate General of Tech. We have Mr. Arnaldo Purba PhD here. Good afternoon, Mr. Aldo. Halo, Mr. Aldo.
Good afternoon, Pak Bagus.
Lama nggak jumpa ya, long time no see.
Ya, apa kabar?
Actually, Mr. Aldo is my college mate, so I'm pleased that we can meet here in this forum. Before I start this presentation, I will read short biography of Mr. Aldo. Please, operator, Mr. Aldo CV, please. Okay, Mr. Arnaldo Purba, or I call Mr. Aldo, now appointed as Section Chief of Automation Exchange of Information 1, Directorate of International Taxation, DGT. He started his career after graduating from Indonesian State College of Accountancy and commenced work for Indonesia Tax Authority. After 14 years service, Dr. Aldo left to pursue his master's degree at Waseda University in Tokyo, Japan. And then he was awarded an Australia Award Scholarship, which allowed him to complete his PhD in the Research School of Accounting between July 2014 until July 2018. Aldo then returned to Indonesia and continued working for the Directorate General of Tax. He has worked in a range of areas, including the International Cooperation and Tax Treaty Division and the International Exchange of Information, IOI. Ladies and gentlemen, please welcome Mr. Aldo. And Mr. Aldo, the floor is yours.
Thank you, Pak Bagus. Good afternoon, distinguished officials, panelists, and all participants. I'm honored to be here. Today we'll talk about tax challenges arising from digitalization of the economy and what options do we have to address them. I will limit my presentation to direct taxes only because, as you all know, indirect taxes, like I think, can you please show up the title section? The first slide, please. Yes, thank you. So I will limit my presentation to direct taxes because, as you all know, indirect taxes like VAT or GST has much less issues compared to direct taxes such as income tax. In fact, the OECD BEPS Action 1 report on tax challenges of digitalization of economy, for example, issued in October 2015, had no consensus on income tax changes, but recommended VAT for taxing online sales. Next slide, please. So there are some facts that I would like to highlight. The first one is we have seen fundamental shifts in all aspects of international businesses, particularly in the past 2 decades, from how they invest, through how they make money, how they distribute profits and deploy capital. These companies continually change their tax strategies, but unfortunately, tax regulations seems not to catch up with the changes in the business sector. On the other hand, tax treaties, as they presently stand, generally reflect traditional concepts of source-basis taxation, right? Those concepts are based on physical presence of one sort or another, as opposed to the mere existence of a market or users. On the other hand, the digitalized economy presents tax systems and tax administrations with new and difficult issues. Industry participants operate on a worldwide basis and in some cases are extremely profitable. They are able to penetrate markets with actually little or even no physical presence in them. However, this is also true for some non-digital companies, not only digital companies. Next slide, please. Now, there are at least 3 options to address the issue of taxing the digital economy. Let us briefly look at one by one. So the first one is unified approach. For those who haven't heard about this terminology. So there are 137 member jurisdictions joined the so-called inclusive framework on BEPS, or sometimes we call it simply IF. So IF has been working hard to formulate the taxation, concept on a digital economy known as a unified approach. So in terms of scope, unified approach covers automated digital services, ADS, and consumer facing business. I think I don't have enough time to explain this, but hopefully you can find a definition from the internet if you are not familiar with those. In terms of revenue threshold, M&E subject to global revenue threshold and de minimis rule that pays down over 5 years. And that means this unified approach will apply only to approximately 700 to 1,000 giant multinational enterprises. This is according to OECD impact assessment. In terms of implementation instrument, we will need a multilateral instrument, a multilateral convention in this case. So the 137 members have to agree on this unified approach in order to make it effective. In terms of tax base, unified approach will be based on multinational enterprise group consolidated financial accounts with some possibility for adjustment with some, in my opinion, complex additional features, such as if you're familiar with this unified approach, segmentation and loss carry forward, and so on. The discussions about unified approach involve not only technical, but also political, and negotiations seems to be in, I don't want to use the dead end terminology, but yeah, it's challenging. Okay, that's about the unified approach. Let's move to the second option, unilateral measure, the one in the middle. So several countries have introduced a new type of tax, such as digital service tax in UK, Italy, and French, equalization levy in India, and advertising taxes in Austria, for example. There are several reasons for them to implement unilateral measures, such as, political dissatisfaction on the plan to have global consensus around whether digitalized businesses or business in general are paying their fair share, or whether market countries have their fair share of global taxing rights, or even the arm's length principle, ALP. Is it still produces appropriate results or not? So that's about the second option. And the last but not the least is the treaty modification. So currently the United Nations Department of Economic and Social Affairs, UNDESA, has established a committee called the UN Committee Approach on Tax Consequences of Digitalized Economies Issues. So this committee works independently to propose a new Article 12B on digital services in UN treaty model. And this new article will give special attention, that's what they promise, to interests of developing countries. For example, it will regulate allocation of taxing rights in respect of automated digital services. If you can go to the next slide, please. So this slide contains more detail about the three options. So I call these options, but actually these are not easy options. So these are some issues in respect of each option. So for unified approach, there is a complexity issue. So many developing countries criticize the unified approach as too complex. So if you ever heard of the Pillar 1 proposal, this establishes a global corporate tax base to be shared among countries, rather than subjecting corporate income to separate country corporate tax bases. So this is a huge structural change that countries should consider carefully. For example, amount A belongs to the Pillar 1. This is the new tax, assuming that we will reach the consensus. Amount A is a residual profit apportioned to market countries without regard to physical presence. So based on in-scope country revenue to total in-scope revenue. So even though an MNE in Indonesia, for example, runs a business and earn a significant amount of money, it doesn't mean that that MNE will pay tax on amount A in Indonesia. If globally the MNE ends up with loss rather than profit, then the MNE will pay no amount A in any jurisdictions. And another issue is that does unilateral means without the consent of a particular country, for example. So the big question is consensus achievable? So we all hope that it is, but you know, the discussion is until now is challenging. And another issue that we need to be aware of is the dispute prevention and resolution. So it is mentioned in the proposal that the amount A will use panel for agreement with MNE on base and allocation, mandatory binding arbitration for amount A. So this is something new for developing countries, including Indonesia. Issues regarding unilateral measure, there is an urgent need for greater tax revenues throughout the world, right? Especially in light of this current pandemic. And developing countries sees the digitalized economy as a potential source of needed tax revenue. This view actually is shared by most developing countries as well. But the problem with digital services tax, this is the type of the most common type of unilateral measure, DST, is that the potential multiplicity of such tax regimes with conflicting and possibly overlapping rules. If Indonesia applies, then some other countries also applies the same type of new tax. With regard to the third option, 3D modification, so this means that 3D is a bilateral agreement, right? So we have to change all treaties to accommodate new taxing rights by source or market jurisdiction. So the issue here is the negotiation capacity. So do we have enough resource to, to achieve what we want to? And I think even what we have now, especially in developing countries, we have relatively limited tax treaty networks. In Indonesia, for example, up to date, we have 70 treaties compared to developed countries. I think on average, they have 100 treaties or more. So those are the issues. I would like to go to the next slide, please. All right, so this picture shows the proliferation of unilateral measures proposed or adopted by countries, either DSTs, equalization levy, advertising taxes, and so on. So from this picture, we saw that quite a lot of jurisdictions, at least, have enacted legislation. So in a green color, we can see there are 22 jurisdictions that have enacted legislations. This includes Indonesia. So enacted doesn't mean that the jurisdiction has implemented the direct taxes. No. Unfortunately, this report issued by KPMG doesn't include the countries that have implemented the direct taxes on digital taxation. So I think the highest level in this case is the countries that have enacted legislation. So we have to, I think, to be careful to read this picture. But the message here is that more and more countries, I think, will at least introduce legislation when they see that the global consensus is getting far away from what they are hoping for. Okay, I will try to keep my time, and shall we go to the next slide, please? So in the current environment, the short-term revenue needs will tend to dominate other priorities. So in this case, I think some countries will consider to have MLI2. MLI2 is the treaty negotiations to enable, prompt authorization by treaty of greater source taxation. And some others may consider unilateral adoption of instruments that will add revenue, including DSTs. But again, the devil is in the detail, so there is no easy option, I think. And also implementing countries may need to be aware of countervailing pressure, not only from the United States, in the recent case, U.S. against asserted discrimination against its companies, and also from the other countries to limit measures, expanding market taxing rights to categories of digital, particularly B2C, for example. So this is something that we need to be aware of as well. And next slide, please. So what is the best option? This is a simple question, but actually very hard to answer. So if you ask me, I don't have the answer, but in my opinion, unified approach still the ideal solution in this situation. But again, please do not add in complexity and need to recover a fairness in the design. And we need to involve in all the discussions, because the discussions involve not only technically but also political decision. And we all know how politics really works, is that when you are not at the table, you are on the menu. Therefore, we need to be actively attending the meeting and providing comments to make sure that the consensus reached is the one that we hope for. I think that's the last slide, and I'll stop here. Back to you, Pak Bagus. Thank you very much.
Thank you, Mr. Aldo. That's very good presentation, Mr. Aldo. While Mr. Janur discussed about indirect tax, custom duties, you limit your presentation only direct tax, corporate tax, or income tax. From your presentation, I underlined the three options regarding the direct taxation matters. The first option is unified approach by OECD, and second, unilateral measure, and treaty modification by UN Department of Economic and Social Affairs Community. Mr. Aldo also stressed his presentation that Indonesia Tax Administration need to be cautious to tackle this issue because there is countervailing pressure from other countries. Okay, Mr. Aldo, thank you for your presentation. The next panelists come from OECD, the Organization for Economic Cooperation and Development. We have Mr. Andrew Orbach. Good afternoon, Mr. Andrew. Please.
Good afternoon.
Good afternoon, Mr. Andrew. Selamat sore.
Selamat sore.
Bagaimana kabarnya di Jakarta, Mr. Andrew?
It's good. Bagus. It's apa kabar?
Baik, bagus. Okay, let me read Mr. Andrew's short biography first. Mr. Andrew is OECD tax representative in South Asia, based in Jakarta. Andrew is a Canadian and US trained lawyer and has been with the OECD Center for Tax Policy and Administration since 2007. His work has spanned the full range of issues that dominate the international tax policy landscape, including BEPS, promoting exchange of information and tax cooperation, tax certainty, and tax policies for inclusive growth. Prior to joining the OECD, Andrew worked in private sector, providing corporate and international tax advice to clients in both US and Canada, and also as a legislative drafter with Canada Department of Finance. Andrew holds law degrees from Osgoode Hall Law School and the University of Montreal, as well as an LLM in International Tax Law from New York University. Okay, Mr. Andrew, without further ado, the floor is yours.
Thank you very much, Pak Bagus. Thank you to Professor Mardiasmo, DG Hudegal, Director Arsal, and Director General Heru, and all the participants here, and particularly my colleagues on the panel here. Some of whom I've met before. Either I've worked with Pak Daldo at DGT. It's a pleasure to be on the panel here, and also I've met a number of you at the at previous times I've been to the institute in person. So sadly we can't do that in person today, but I'm glad to be here. I want to pick up on what really Pak Aldo's presentation. He's a bit of a tough act to follow, I think, in this case. Where maybe I have to make the case a little bit for the unified approach, but I think it's good to have. I think the context of where the work that the OECD is doing, the inclusive framework, is doing on trying to make sense of the international tax rules and to see where they can go in the future. I note as well as it's already been mentioned. That my director, Pascal Saint-Amand, will be here tomorrow to discuss digitalization and tax as well. And I'll leave him to handle the more delicate political questions and how the discussions are shaping up. The key question, of course, is how digitalization, and Pak Janu gave a very good summary of the impact that digitalization's had on the economy, and of course the tax rules that we're working with in the international area are about 100 years old. So the rules are really not well designed for the types of business models that we have today. And the inclusive framework, as Pak Aldo had mentioned, they are working hard, and in fact on the 8th and 9th, so on Thursday and Friday of this week, they will meet virtually to discuss the so-called Pillar 1 and Pillar 2. Now, there's been a lot of talk about the end of 2020 as a deadline for delivering a global consensus solution on these issues, and suggestions that this is kind of do or die, or that maybe we've reached a dead end, as some people may say or not say. And I think it's important to kind of look back a little bit and see how far we've come, and try and understand then how far we can get. The international community has had a long dialogue about how to adjust the international tax rules. The BEPS project, base erosion and profit shifting, led by the OECD countries and G20 countries, is about trying to bring some coherence, transparency, coordination to the taxation of multinationals. So really applying the rules on how to allocate profit between jurisdictions and the nexus rules as they exist, how to make sure that they're applying correctly. And when the BEPS package of measures to address corporate taxation was released in 2015, Action 1 of the 15 actions was about the digital economy and digitalization of the economy, and the digital component of the economy was really putting a lot of stress on the international rules as they are. Now, as Paraldo already mentioned, the Action 1 report did not come away with, but in addition to that, I mean, we also agreed, as has been mentioned, this question about VAT prior to the Action 1 report, the question of who should apply VAT to a digital service or goods provided over by digital service providers was unclear. And a lot of those transactions fell between the cracks. And now we have a clear destination principle that has come out of that work and is applied by over 100 jurisdictions, including Indonesia. And the results over the last few years has been tremendous in terms of generating revenues. In fact, really far exceeding expectations with the VAT collected. But again, no consensus on what to do with the direct tax rules. But in 2017, there was a kind of urgency, a further urgency brought to this. And this was really, I think, an impatience on the part of politicians, taxpayers, the public, identifying this issue as something that was really of great concern, both as a question of fairness, a question of digital companies competing fairly with traditional businesses, with big taxpayers not paying enough tax. And so there was a lot of pressure, and there was also a lot of talk beginning to come out about unilateral measures. So we've heard from Aldo about the options the countries have, and certainly unilateral measures, DST type solutions, were being talked about. And so the pressure to come up with a global consensus on direct tax was grown. In 2018, the inclusive framework, 137 members, including Indonesia, including a lot of developing countries, including financial centers, OECD G20 countries, came up with a report. So if you compare side by side Action 1 report in 2015 with the interim report in 2018, what you see is the problem coming into focus. That, first of all, I mean, these issues that Pak Janu had mentioned about scale without mass, about the ability to penetrate an economy, were very much identified, but also that it's not about select digital businesses, it's about the digitalization of the economy as a whole. And, you know, Pak Aldo mentioned this question of consumer-facing businesses, even traditional businesses that are providing services or goods to consumers rely a lot on digital aspects, on algorithms, on designing, on getting feedback from their product, et cetera. And so it's not just Netflix, Google, but it's really the broader economy. Now, at that point, I would say there was maybe a clearer idea of what the problem was, but not really a clear idea on what the solution was. Some people thinking still really needed to really just deal with big digital businesses. Others more wanting to wait and see on how the BEPS actions themselves would solve the issues, or at least alleviate the issues. And others wanting to go beyond really just direct tax and really see, maybe reassess how the arm's length principle was working, and the traditional nexus and profit allocation rules. So the 2018 report really set that in motion, but also started work on talking about digital tax administration, virtual assets, how they're to be dealt with. And so the bigger question about tax and digitalization were being laid out there for future work for a global kind of examination. And since 2018, we've now developed these ideas further. We've come up with the unified approach to try and deal with the profit allocation and the nexus issues. But beyond that, we've also looked at a global kind of minimum tax, a kind of pillar 2. And this is, not directly about the digitalization of the economy, but it's about the globalization, and it's about the interaction of international markets, and to try and prevent the race to the bottom and put a minimum level of tax. So the package of measures to deal with digitalization includes a pillar 1, which is about redefining the nexus rule so that it's not limited to physical presence, but also, and this is it's crucial, once you have nexus, you need to be able to allocate the profits based on something other than the arm's length principle as it exists, because as it exists, it would not allocate profit to those jurisdictions where there's no physical presence, because the functions and risks in that jurisdiction are not going to support that profit allocation. And so, as you've heard already, it's about a residual profit that's allocated to markets based on the market share, with some adjustments, and it's complex for sure, but it's trying to get a global solution that will fairly redistribute profit to all jurisdictions that really have a share in the pie. And pillar 2, which is that we ensure that the race to the bottom stops at a kind of minimum level. Now, we've published to date, kind of high-level outlines of this. The last document that was published was an outline of the architecture of the solution of a global proposal. And right now, what the inclusive framework is working on are the blueprints for how those work. And these are very detailed. It's international tax. And so I think we have to accept that if it's going to be a good solution that's going to work, it's got to have some complexity, because the issue is complex. And so as was mentioned already, about defining the tax base, about how to allocate the profit, about the scope, who's in, who's out. These are subject to rules that people are going to have to figure out how to apply. But we do understand that we need a global consensus. It's 137 jurisdictions that will be trying to come together on this. And that's a lot of different constituents, developing countries, smaller financial centers, emerging markets, advanced economies, et cetera. And so what we will produce very soon, as I mentioned, this Thursday and Friday, the inclusive framework will meet to discuss the blueprints. The idea is to publish them for public consultation. We are at a point where I wouldn't say dead end in terms of the negotiation, but we're certainly, the COVID pandemic has given us pause. But I really think that this is not facing the edge of a cliff, meaning if we do not get agreement now, then we pack up our bags and go home. Because looking at the 3 options that Pak Aldo laid out, a global consensus, a unified approach, or kind of a bilateral solution, it seems to me that a multilateral approach is what everybody wants, what everybody hopes that we can agree. And frankly, looking ahead, it's hard to imagine that the world will not be able to agree rules along those lines, because they're needed to really bring certainty to the international tax tax framework, and to really provide the landscape in which business can operate. Now, how we get there is another question. There are a lot of political decisions to make. The scope, the minimum tax threshold, et cetera. These are difficult questions, and we are still at a stage where we need politicians to be able to agree those. But we're very far advanced in terms of designing what a global solution would look like, and I think that's an incredible achievement of the international tax community and institutions that have been built up. I think I'm pretty much at the end of my time. Again, my director will be here tomorrow and can take that discussion a little bit further in terms of what the contours of those political discussions are like and what the medium term or near term hold for those discussions. But we're certainly very, very sensitive to the needs of the full range of constituents. So thank you very much, and I'm happy to answer any questions that you have.
I thank you for your nice explanation, Mr. Andrew. You recite the history of digital project and where we have come to since PEP Action 1. And you explained that the timeline agreed in the G20 is to develop a consensus-based solution by the end of 2020. So this is not only needs to revisit fundamental aspect, but also is reflective of the political aspect of all members. So I hope you success with your next meeting to discuss the blueprint. Thank you, Mr. Andrew, once again, thank you. Now we will move to the next panelist. The last but not least, Mr. Luis Carrillo from BVD. Good morning, Mr. Carrillo.
Good morning. Thank you for having me here. Assalamu alaikum.
Waalaikumsalam, Mr. Carrillo. What time in UK right now?
Oh, it's a fresh start of the day. It's 11 in the morning.
Oh, okay. I will read a short biography of Mr. Carrillo. Mr. Luis Carrillo is a TP specialist with 14 years of advisory experience, including Big Four. He is a senior director of TP solution at Bureau van Dijk, a Moody's analytical company, and responsible for guiding BVD value proposition in the transfer pricing market, which include tax authorities, advisory firms, and multinational corporations. He also conducts transfer pricing training with numerous tax authorities on the use of BVD's tools and TP best practices. Mr. Carrillo holds a bachelor degree in economics from the University of California, Santa Cruz. Mr. Carrillo, please deliver your presentation. Now the time is yours. Please.
Thank you very much. I really appreciate the invitation to having us speak here today. And let's see, can we have my slides up on the screen? Perfect. Yep. So obviously today the topic has been about digitalization. Now there are many aspects to the topic of digitalization. Today most of the presentations have focused on the digital economy and e-commerce and the implications of this brave new world where everything is online and digital in terms of taxation. I'm going to change the topic slightly here, and I'm going to speak about digitalization in general and how digitalization is something that can help tax and customs administrations to be able to better focus on the risk areas and how to better tax and identify areas of risk within multinational corporate groups. So if we go to the next slide, the first part of my presentation is simply talking about some of the challenges that are faced by tax administrations, but the same challenges are faced also by customs administrations as well. And the main issue, as we heard today in the earlier presentations, is that globalization is causing a lot of amalgamation of the industries. So more and more you have, smaller companies being acquired by bigger companies. You have a local national specialist company and it becomes subsidiary of a bigger companies. So both the expansion of multinationals as well as the consolidation of the industries tend to increase the risk of base erosion and profit shifting among multinational groups. Another big challenge that the tax and customs administrations face is the lack of visibility that tax and customs authorities have beyond their national borders. So, most of the countries, they have very good internal, local, domestic data on taxpayers, etc., from all the different sources that there are. But once you go beyond your national borders, that visibility dissipates dramatically. And obviously, the BEPS project has helped a lot in terms of improving the situation through exchange of information protocols and through increasing transparency. But the exchange of information protocols are quite slow, and they're not automatic. You still have to prove why you need the information from the other tax administration, etc. And basically, there's a lot of complexity in the transfer pricing world regime. It's difficult to reach consensus, and oftentimes it's also very difficult to obtain the necessary data with which to establish arm's length standards for the allocating profits correctly. So all these different challenges are things that tax administrations are facing. If we go to the next slide. To illustrate the challenge, in our databases, as you know, we publish information on companies. We've had more than 5 million changes in ownership within multinational groups in the past year. This is a huge figure, and it illustrates how much transferring of assets, transferring of value, potential restructuring, potential reallocation of intangibles, etc., can happen on an annual basis worldwide among multinational groups. If we go to the next slide, this is a really funny slide because it depicts what one multinational group looks like in terms of their geographic footprint. This is basically the org chart of a company. And as we had to make it miniature in order to get it to fit into one slide. But if this is one typical multinational, imagine how complex it is for the tax authorities to figure out where the money goes and where the footprint of the taxpayer is, where every single one of these little dots here is a subsidiary located in a different country. So these are some of the really big challenges that face tax administrations as well as customs, because in customs you also have very similar challenges. You need to know if there's a relationship between the importer and the exporter. You need to make sure that the importer is not circumventing restrictions using triangulation via a different subsidiary, etc. So there's a lot of issues where the lack of visibility really becomes a problem for enforcing the existing tax and customs regimes, as well as for assessing what policy should look like in the future. So if we go to the next slide. So the one answer to this issue is digitalization. I think there's more and more information becoming available thanks to digitalization in the public domain, and this digitalization environment is helping governments get the tools that they need in order to have more visibility, more information on taxpayers, on multinational enterprises, and to be able to better establish the right types of policies for for their own domestic countries. So if we can go to the next slide. And so at the moment, there's a big push by many countries to enact, to put into place digitalization technologies, to put in place big data projects that help give more light and more information. Some of the most advanced tax administrations that are embarking in this type of solutions include Australia, Brazil, the United Kingdom. In these countries, for example, they have big projects where they are combining information that they have from the taxpayer, from the customs, and combining it with data they get from the public domain, from external sources, etc. And this kind of push is something that's going to enrich the visibility of the tax administrations and the customs authorities so that they are able to better assess the potential risk of tax of base erosion or of profit shifting, or even of financial crime and money laundering and these other types of issues. So at the moment, we are working with 20 different countries that are embarking in this type of digitalization projects to help shed light. So this is a big trend, and it's important, that everybody understands that this is the future direction of tax administrations, because it will also help encourage disclosure, transparency, and compliance from the part of taxpayers. If taxpayers understand that less and less it's becoming, possible to hide, their structures and to evade or avoid taxation, then it'll be a lot easier to get taxpayers to be more compliant and to be more transparent with their structures and to pay the right amount of tax in the right place. So that's the idea with this digitalization type projects. If we can go to the next slide, please. So the type of information that's now available in the public domain include different types. So if we go to the next slide, we have most tax administrations, most customs administrations are able to get information from the taxpayer declarations. Okay, that's the main source, because most taxpayers have to declare and disclose a lot of information to customs as well as to the tax authority. But tax administrations are also able to get a lot of information from the banks and the pensions funds, information from customs, as well as from immigration services. Being able to talk to each other helps facilitate and cross-reference the flow of goods, the flow of transactions, the flow of people and assets. You also have the exchange of information protocols with foreign governments that we mentioned before. Then there's also a lot of information from the public domain, as well as from third-party vendors like Bureau van Dijk, like us. If we go to the next slide, please. The type of information also that is available today is much richer than what used to be available, say, 5-10 years ago. For example, there's a lot more information on people, on the directors of companies, on the top management of companies. There's a lot more information on beneficial owners, information on corporate structures, information on banks, insurance companies. So all this data that is out there is available from many public sources, and it's the ability to gather all that data and collect all that data and integrate it into the systems of tax administrations that's really helpful. Can we go to the next slide, please? So among the types of data that's in the public domain, you also have things like news, negative news, industry research, M&A data, information on royalties, information on loans, information on commodities. There's a lot of information on politically exposed people and sanctions, information on patents and other intellectual property. There's information on anti-money laundering documents, etc. So there's quite an array of information that's now available in the public domain, which digitalization is helping harness for the purpose of gaining visibility and more transparency for for multinational enterprises, definitely. In the next slide, we can see that all of this information basically is currently being used by tax administrations and by customs administrations to connect it into their systems. So in this slide, you can see here that you can take the external data, for example, the data from Bureau van Dijk, and take the data from the tax administration or from the customs administration, and you can combine it and do a data matching of the information that's in the public domain with the confidential internal information based on the taxpayer ID or the importer ID record. And once you have the matching, you can discard the duplicates or the false positive data. And then once the information is blended, then you can build analytical tools that give the ability to visualize information much better and to be able to produce research that can lead to policy, as well as you can produce criteria that helps capture potential taxpayers with risk of tax avoidance or base erosion or profit shifting. If we go to the next slide, we can go to so an example of how this information can help tax administrations do their own internal risk assessment and to gain greater visibility on taxpayers is illustrated in this example. So if we go to the next slide, basically the idea is that you can use these digitalized platforms and big data to establish risk rules of known tax avoidance patterns. And we can use these risk rules to identify potential audit targets, and then tax inspectors, with their knowledge of the taxpayer and the industry, they can choose the best cases to investigate. If we go to the next slide, we have an example basically where we put criteria here. We looked for Indonesian companies that have a shareholder located in low tax jurisdictions like Singapore, like Bahamas, Bermuda, etc., and which have basically an interest cover ratio of less than 1 for the last 3 years. Having an interest cover ratio of less than 1 basically means that these companies that we found have potential risk of paying too much interest payment to foreign jurisdiction. So we found 11 potential Indonesian companies that have this low interest cover ratio and with a presence in these low tax jurisdictions, which could be a red flag for potential, profit shifting by means of the interest deduction that they can take in the tax return, as well as the payment of interest, of high interest to a low tax country. So in the next slide, we can analyze the the results of these 11 companies, and we can see that these 11 companies have the amount of interest they paid in the last year, the size of the loans, the size of their long-term debt, their EBITDA, and we can see also where the global ultimate owner of these companies is located in different countries. So the third company down the line, you can see the ultimate owner is the Singapore company. So there's some potential examples of really high risk taxpayers here in this population. So this interest rate deduction abuse and inter-group financing risk can be an issue that can be potentially an area that you can focus on for these particular taxpayers. In the next slide, we looked at one of these 11 companies, and we saw that the parent company is the one in red, which basically is located in the Cayman Islands. The next big company there in the middle is the Indonesian company, but the Indonesian company is the parent of several subsidiaries that are located in the Netherlands, in Singapore, in Cayman Islands, and Indonesia as well. So this particular corporate structure is potentially an aggressive tax structure that can lead to potential profit shifting or tax avoidance. So this information here is all coming from public domain information. It's the ability to map and link this information together that becomes really valuable, and which digitalization can help bring into light very fast and with minimal effort. In the next slide, we can see again the target Indonesian company we were focusing on, and we can see that in the prior 3 years the company had consecutive operating losses, and it had consecutive high interest payments for those previous years. So it's quite interesting to see the impact that this potentially can have. One can question also whether a bank would have lent this company money at a low interest rate if it has this kind of profitability, consecutive losses, etc. It's very likely that the loans are probably coming from a related party. So there could be transfer pricing issues arising from this company as a result of the high likelihood that there is intra-group financing in this company because of the consecutive losses and its inability to get funding from a third-party bank. So if we go to the next slide, I think that's we're almost there. But this example pretty much helps illustrate the ability that big data can have on giving tax authorities the tools that they need to better track taxpayers, to see what the structures look like, to see what the footprint of profits is, what the footprint of IP, financing, etc. And it can be a very powerful complement to the other tools, to the exchange of information protocols that are receiving due to from foreign governments. So this information can really have an important impact, and this is all thanks to digitalization. It's a different aspect of digitalization, but it's digitalization nonetheless. So we need to basically recognize that these solutions exist, and we need to basically use every tool available to help tackle these big challenges that we face, especially as the world evolves and becomes more and more digital so do the tax authorities and customs administrations have to become more digital. Thank you very much. That's it for me. I appreciate that this is the end of the the end of the day for you. So I tried to keep my presentation as short as possible. But yes, I'm available if anybody has any questions.
Okay, thank you. Nice presentation, Mr. Carrillo. You have explained to us the use of big data for digitalization of tax administration and blending the external data with internal taxpayer data from custom authority, tax authority, Bank Indonesia, on other ministries, so we can compare our data and get some accurate information from taxpayer, so we can make a better taxation policy. Big data can be used to establish risk rule based on known tax avoidance pattern, and risk rule will help identify potential audit targets. And for tax inspector, with the knowledge of taxpayer and the industry, can choose the best cases to investigate. Once again, thank you, Mr. Carrillo. Ladies and gentlemen.
Thank you very much.
That is all nice and interesting presentation from our panelists today. Very comprehensive discussion today. We discussed the impact of digitalization from many sides, from many perspectives. Mr. Janur explained the indirect tax or custom duty from digital good. Mr. Aldo explained about direct tax and their three options regarding direct taxation methods from digitalization. While Mr. Andrew explained about the OECD project, that's very, very secret. And Mr. Carrillo closed this discussion with the urgency of big data to digitalization and to make a better taxation policy. May I ask you to all the participants and all the audience here to give a big applause, virtually of course, to our respectable resource persons. Ladies and gentlemen, now we continue our agenda with Q&A session. We have, wow, we have some question from the first question to address to Mr. Janur from Mr. Wahyudi Bahtiar. Electronic transaction tax rules have been published. When is the right time? To implementing the custom policy for digital goods. As previously explained, the potential for revenue is quite large. Mr. Janur, please.
Thank you. Thank you, Bapak Wahyudi Bahtiar, for your suggestion. Currently, although the import duty is still 0, but many companies, especially telecommunication company, have declared using General Declaration (PIB) based on Minister of Finance Regulation number 17. So any company have declared. Thank you.
Okay, sorry. We move to the next question from Ms. Rafida Muhammad Nur. The question is for Mr. Aldo. Mr. Aldo.
Yes, Pak Bagus.
Yes, you still with us?
Yes, I'm here.
Okay. How the government of Indonesia level best to balance up between the loss of tax revenues and the introduction of tax measures in mitigating the COVID-19 pandemic, maybe from the digital economy perspective? Thank you.
Pak Bagus, can you repeat the question once again, please? Sorry, I have a little bit of connection issue.
Okay. The question is how the government of Indonesia level best to balance up between the loss of tax revenue and the introduction of tax measures in mitigating the COVID-19 pandemic, maybe from the digital economy perspective?
Yeah, thank you for the question. This is a very tough question, I think. And in my opinion, if you ask how to balance, I think at the moment the government is still trying to focus or to get the commitment, to keep the commitment to the global consensus. So actually, in terms of taxation of digital economy, Indonesia, the government of Indonesia has not implemented the policy. Yes, we know that the government has issued the regulation, has introduced Perpu 1, 2020, but the implementation regulations have not introduced. So in that case, I think how to balance is not the question for in terms of digital economy, but I think Indonesia is trying to be part of the global consensus, and for the COVID-19 pandemic, yes, we do need as I mentioned in my presentation as well, many countries, especially developing countries, are trying to collect as much tax revenue as possible. But then we are facing some issues as well. If, let's say, we introduce the unilateral measure, for example, that's, I think, at the moment is not a good way to collect tax revenue. I think that's my comment on the question.
Thank you, Mr.
Thank you.
If I may just jump in here really quickly, I think another important point is that I think in this kind of situation with a pandemic like this, it becomes more important to be able to collect the full tax, to close the tax gap that exists already between what people should be paying and what they are actually paying, rather than increasing the taxes, etc. It's going to be much harder politically for countries to raise taxes in general than to enforce the existing tax legislation. And this is also where this kind of digital solutions help governments to close the tax gap, to reduce the amount of lost tax revenue that they should be collecting with the current framework of taxes that are in place.
Okay, thank you, Mr. Carrillo, for your addition. We move to next question. This next question from Mr. Ruston Tambunan. This question addressed to Mr. Andrew. There is two questions. The first question is, how optimistic would the OECD inclusive framework reach the global consensus on digital taxation by the end of 2020? And the second question, just in case the consensus is not concluded by whatever reason, countries tend to adopt unilateral measures that most possibly will end up with double taxation. Is there any proposal from inclusive framework to cope with this issue? Mr. Andrew, please.
Yeah, thank you. Excellent question. Maybe I can just pop in on the previous question briefly as well, and to agree with Mr. Carrillo in terms of the digital aspect, and to kind of collect as much tax as you can from your existing measures. I mean, this is not necessarily the time when you want to be imposing additional taxes to try and collect more revenue. On the digital side, of course, we do see that the pandemic has made a lot of the big digital companies even richer. And so they do make a better target in some respects. In terms of the optimism about reaching a global consensus in 2020, the answer is not very. In fact, there are very public political stances particularly involving the United States, which number one has indicated that they want to investigate a kind of safe harbor approach to the Pillar 1, meaning companies could kind of opt in or out depending on how they felt about it. And of course, that's not really acceptable to a lot of the other people around the table. So there's quite an issue to be resolved there. And more recently, the United States has sought a pause in the negotiations, chiefly because of the pandemic, but also because of the US elections that are set to take place next month. So the prospect of a solution in 2020 is not good really at all. But what we hope to achieve at the end of this week is to really put the progress on the table and to publish it, and so that people can see where we are and what the prospects for that solution are. Of course, you're absolutely right. Countries are looking more towards unilateral measures. Aldo, in his presentation, had a very good slide there about where different countries are, about 20 or more around the world that are making proposals there, including Indonesia, at various levels. Now, we do think that is going to be difficult for business and difficult for countries to live with. There will be double taxation. There will be a lot of confusion there, and there will be trade reprisals, not just from the United States, but there will be a lot of concern from different countries. So it's not a solution, and particularly in the context of the you have to ask yourself whether stoking trade disputes is going to help the recovery or not, assuming we can get to a recovery. And so that is going to have to enter into the tax policy decisions that go along with that debate. We hope that the solution to the unilateral measure is a global consensus, but there's work to be done.
Okay, thank you for your answer, Mr. Andrew. Because of our limited time, we have the last question from YouTube live streaming. This question addressed to Mr. Aldo and Mr. Andrew. Should Indonesia, in mobilizing revenue to finance economic stimulus, introduce a unilateral measure to tax digital economy, or wait for lingering the discussion on unified approach? And next, how to mitigate retaliation action against the unilateral measure, like the US trade investigation on French digital service tax? Please, Mr. Aldo first. Mr. Aldo, you still with us? Okay, Andrew, you can answer first.
Yeah, I was looking forward to Aldo's answer, but look, I think, number one, it's important to underscore that the inclusive framework has done specific work on interim measures, or measures that countries could take on their own to try and bridge the gap, because the inclusive framework recognizes that there's a real political imperative and economic imperative to ensuring that you have fair taxation. But we would like to underscore that those are viewed as interim measures, not as permanent measures. And the idea is to bridge the gap with a global response. Now, of course, we do understand that, what do people say? There's nothing more permanent than a temporary tax. And so you have to be careful. Once you start collecting revenue, it's hard to give that up. But we do recognize that people are under a lot of pressure to act, and so we see that as inevitable. But at the same time, as the second part of the question highlights, well, what are the consequences of that, and how are they going to look for countries? I mean, are they really going to collect as much revenue, and what are the downside risks of doing this? And of course, business will have a big say in that, because my understanding from business is that what they're really afraid of is not a tax, but being taxed on more than 100% of their profit. And a DST that goes after 3% of revenue can easily add up to a very, very high percentage. So I think there's going to be, it's not as simple as it seems, the unilateral measure. And we hope that we've made enough progress that there's still a lot of buy-in for the consensus approach.
Wouldn't the happy medium be a situation where there's a consumption tax for the sales that take place in a country, and then an income tax on the functions and risks of the taxpayer and where they have their value chain located?
Well, yeah, on the VAT, the consumption tax side, absolutely. And I mean, that's part of the, the consensus that we do have on the destination principle. It's been hugely, I have made a huge impact as a revenue raiser in a lot of countries that have introduced, they've well outstripped their expectations. But on the functions and risks, I mean, the very problem is that, Google is earning revenue from a market where they have no functions and risks. So there's no, there's the allocation rules will not, as they're currently drafted, will not allocate any profit to those markets. And so we need to go beyond those rules that exist in order to get to the proper taxation of the market. And that's what we're trying to work on.
Exactly, but a tax on the company, on the actual, a tax on Google for its sales in a particular country where they have an operation. So a sales tax not on the consumer, but on the company, suppose, as opposed to it being an income tax.
Yeah, a tax on the profit, whether it's from the sale of goods or the sale of advertising revenue that it gets in respect to that jurisdiction.
Okay, thank you, Mr. Andrew. I have a message from Mr. Aldo, Pak Bagus, and all. My apologies for having to leaving this session sooner than I expected. So, okay. Actually, we still have question in Q&A box, but due to our limited time, I have to end this Q&A session. Thank you for your active participation. Ladies and gentlemen, Alhamdulillah, thank you very much for this fruitful discussion today. Before I close this panel, let me wrap up and summarize this discussion. Today's business environment is changing rapidly, and almost all aspects of our life have shifted from manual to digitalization. Of course, it will have a significant impact to custom and tech administration. For the taxation of digital goods, until today, the WTO members agreed not to impose custom duty on electronic transmission. It means that Indonesia will lose the opportunity from some possible revenue. There are three options to address the issue regarding taxation matters arising from digitalization. First option is unified approach from OECD. The second option is unilateral measure, and the last one is the treaty modification from UNDESA. The best option, according to panelists, is unified approach. The timeline agreed in the G20 is to develop a consensus-based solution by the end of 2020. This is not only need to revisit fundamental aspect of the international tax system, but is reflective of the political imperative that all members. And last, blending external data with internal taxpayer data, so we can compare all data and get accurate information from taxpayer, so we can make a better taxation policy. That's all summarized of this discussion. We would like to say thank you to all panelists, all speakers who shared their knowledge and opinion today. Once again, please give a huge applause to our panelists today. Thank you. I also thanks to audience for a great enthusiasm along this session. Thanks for your active participation. And of course, to the committee who has organized this great event. Applause for all. Before I close this session, let me quote some words. The technology does not change the people's basic need or their nature, Priya Ardis. It means that the technology only change the way people meet their basic needs or their nature. I Bagus Arianto, goodbye. Wassalamualaikum warahmatullahi wabarakatuh. See you.
Waalaikumsalam warahmatullahi wabarakatuh. Thank
Terima kasih,
you,
thank you.
Bapak Bagus,
Waalaikumsalam.
Bapak Arnaldo, Mr. Andrew, Mr. Louis Carrillo, dan Bapak Janurindo. Could you please turn on your video, gentlemen, for a group picture for this panel discussion too? Yeah, we also have Bapak Profesor John Huta Gaul. All smile. Thank you very much. Ladies and gentlemen, that's all from panel discussion 2. We would like to extend our sincere gratitude to our event sponsor, which also our co-host for this event, Bureau van Dijk, a Moody's Analytic company. Thank you for all the participants who still join us until this last session. Please do not forget for tomorrow, the second day, we will start on the same time. It's like 1:30 p.m. Jakarta time. Tomorrow we will have Mr. Pascal Saint-Amand, the director of OECD, to deliver the keynote speech and interesting panel discussion regarding the current updates of transfer pricing and tax treaty and MLI. We'll see you tomorrow, 1:30 Jakarta time. My name is Monica Nabilia. Thank you. Stay home, stay healthy. Do not forget your mask, and good evening. Bye-bye.
Thank you, Monica.
Thank you.
Andrew, Pak Janur, terima kasih.
Sama-sama, terima kasih.
Terima kasih,
Pak John,
Andrew.
Prof. John.
Thank you.
Terima kasih, Profesor John.
Mr. Carrillo, see you.
Thank you, Pak Bagus. Terima kasih, Mbak Monik.
Terima kasih, Pak.
Terima kasih.
Ikatan Akuntan Indonesia, akuntan profesional unggul, Indonesia maju. Ikatan Akuntan Indonesia, IAI, telah berkiprah mendukung pembangunan SDM dan transformasi ekonomi Indonesia.
Akuntan memiliki peran penting dalam pembangunan nasional yang berkesinambungan.
Profesi akuntan mendukung upaya peningkatan profesionalisme SDM Indonesia agar bisa optimal berkarya mendukung pembangunan ekonomi yang efisien dan transparan. Melalui Prakarsa 6.1 yang telah ditetapkan sebagai program umum Dewan Pengurus Nasional IAI periode 2018-2022, IAI siap berkarya mengawal perekonomian bangsa ini menuju Indonesia Emas 2045.
Saya sangat mendukung rencana IAI untuk mempercepat program sertifikasi agar para akuntan di negara kita memiliki kreativitas, inovasi, keterampilan, dan memiliki daya saing, dan sekali lagi dalam rangka mendukung pengembangan ekosistem kita yang lebih akuntabel, lebih efisien, goal-oriented, dan inovatif.
Tanggung jawab itu terwujud melalui Chartered Accountant Indonesia sebagai identitas akuntan profesional Indonesia dan telah mendapat pengakuan kualitas secara global. Prakarsa 6.1 berisi 6 langkah aksi dengan satu tujuan strategis untuk memperkuat peran IAI dalam meningkatkan kepercayaan masyarakat terhadap entitas bisnis dan publik dengan menyiapkan akuntan profesional berintegritas siap menghadapi masa depan. IAI melaksanakan tugas dan tanggung jawabnya menyusun standar akuntansi keuangan dan standar profesi, melaksanakan ujian sertifikasi, serta aktivitas keprofesian lain mengacu kepada International Federation of Accountants dan Chartered Accountant Worldwide. IAI for Society dijalankan untuk memberikan manfaat yang semakin besar bagi masyarakat serta untuk mendekatkan profesi kepada publik. Founding Fathers IAI telah menetapkan 2 tujuan pendirian IAI. IAI dibangun untuk mempertinggi mutu pendidikan akuntan dan meningkatkan kualitas pekerjaan akuntan Indonesia. IAI menguasai perubahan, menyiapkan masa depan.